Navya. Okay, so today we are going to discuss about Section A, External Financial Reporting Standards. Okay. Yes. So what do we discuss in Section A, is External Financial Reporting Decisions it is about how we prepare our financial statements. What are the rules and regulations we are going to use? And according to US GAAP, how we have to prepare the financial statements and what are the methods that are available for us when we enter each of our fixed assets, current assets, and non-current liabilities and the current liabilities. How are we going to report them for use by the external and internal users of financial information? Okay. So in Section A, the mostly important topics will be how IFRS reporting is different from US GAAP, and what are the financial statements that we are going to study under US GAAP. Then integrated reporting and the 6 capitals that are used by the organization. Then what is accounts receivable and how do we notify accounts receivable, and what is this known as factoring. Okay, so next up it is about inventory. What are the valuation methods that are present in inventory and how are we going to value them? Then comes investments. So there are 6 methods in which we classify our debt and equity investments. So that we will be going through in investments. Then PPE, plant, property and equipment. These are the fixed assets. How are we going to value them on the financial statements? How do we depreciate them? And what are intangibles? Then comes the reporting for liabilities. So here we mainly focus on income tax, the leases, and also warranties. So next up, it is about owner's equity, dividends, and treasury securities. So later, we will be discussing about the revenue recognition and its 5 steps and also income recognition. Okay. So we'll start with the session. So first up, a distinction between IFRS and US GAAP. So IFRS stands for International Financial Reporting Standards, and US GAAP is US Generally Accepted Accounting Principles. Okay. So what both of them give us the rules and regulations to prepare our financial statements. Okay. And according to the US countries, we will have to use US GAAP. Okay. IFRS is very flexible. It is globally accepted. Any company can use IFRS. But as far as it is for US companies, we will be sticking on with US GAAP. So we will learn the major distinction between IFRS and US GAAP now. So IFRS is principles based. Okay. And US GAAP is rules based. So why is this distinction in the sense? IFRS, as I told you, it is globally accepted method. Okay. When we are declaring it as globally accepted, we will have to give some flexibility because different countries have their own rules and regulations. Okay. And in spite of having different rules and regulations in different countries, if we fix the rules in IFRS, it becomes difficult for the countries to follow. That is why it is principles based. We'll give them the generic principles and the companies, according to the flexibility of their country's rules and regulations, and by abiding by the principles given by IFRS, they will prepare their financial statements. That is why it is principles based, because to make it flexible. But in US GAAP, as this is a narrow rules and regulations, which is applicable only to US companies, we are making it rules based. As and how it is said in the US GAAP, exactly in the same way we will have to follow. Then comes flexibility. IFRS, it is open and more flexible because we've made it flexible that it is acceptable globally. That is why it's made flexible. Then in US GAAP, it is less flexible, applicable only to US related companies. And it has detailed rules which has to be followed exactly. Then jurisdiction. Which countries follow IFRS and US GAAP? There are around 140 plus countries worldwide that follow IFRS. And there are only US based companies which follow US GAAP. Now, one of the examples how different it is in reporting IFRS and US GAAP is with respect to inventory. Okay, so the major distinction is we have four main methods, that is FIFO, LIFO, average cost, and specific identification. Okay, among them, IFRS prohibits LIFO. It never accepts LIFO. Okay, but in US GAAP, all of them are accepted. This is one of the differences. Okay, there are many such valuation differences in IFRS and US GAAP. So next up, we have financial statements under US GAAP. So there are four majorly used financial statements, which are balance sheet, income statement, and the statement of comprehensive income. Then comes statement of changes to stockholders' equity, and later we have statement of cash flows. And after this, there is one more statement called as notes to financial statements. Okay, but that is not exclusively considered as financial statements, but that is also equally important. So first up, we have balance sheet. So balance sheet or the statement of financial position. Okay, so this speaks about the financial position at a point in time. So why it is called as point in time in the sense, if you remember, whenever you prepare the balance sheet, you will write it as of December 31st, 2025 or 2026. Okay, so that is stating that on specific date, that is on December 31st exactly, our financial position of assets and liabilities are as disclosed in the statement. Before December 31st and after December 31st, it may not be essentially the same balances. Only on that specific date, at a point in time, the balances were as disclosed in the balance sheet. That is why it is point in time. Okay. Then, what about our income statement and statement of comprehensive income? So, income statement is a temporary account. It contains temporary accounts. So, why it contains temporary accounts in the sense, every year the account balances which of the accounts that we use in income statement varies. For example, COGS varies from year to year. Okay, and your depreciation expense, it will vary. And the gross profit values that you're entering, it will vary. Okay, so temporary accounts are present in income statement. So it speaks about the performance over a period of time. That means if your financial period is for 1 year, in this 1 year, what are the revenues we generated and what are the expenses we have incurred? Only for a period of time, income statement conveys financial information. Then the financial statement number 3, statement of changes in stockholders' equity. Okay, so there are many investors to our company. Especially, we are speaking here about equity share capital investors and preference shareholders. Okay, both of them, especially the equity share capital holders. Okay, so when they invest their funds in our business, they will be interested to know how these funds are being used and what are the improvements in the investment that we have given as equity shares. They will be interested to know about it. That is why we annually prepare statement of changes in stockholders' equity. If we have collected 100 rupees or $100 from an investor in the beginning of the year, at the end of the year, how much growth occurred to this $100 of investment? That is what they will be interested to know. What are the changes in equity over period? Then at the end, we have statement of cash flows. We know this. So only when actual cash outflows and actual cash inflows occur, we will be entering them in statement of cash flows. Mainly, we will be coming to know about what are the cash flows from our operations, investing activities, and financing activities in statement of cash flows. Okay. So next up, we have about the notes to financial statement. Okay, so notes to financial statement, we don't consider it as a financial statement by itself. You know why? Because financial statements, if you need to consider them as financial statements, they should have monetary information in them. Numbers should be there. When it comes to notes to financial statements, it is just a guidance for us to understand the financial statements very well. If there are some important decisions that a company made, That will be disclosed in notes to financial statements. And if there are any unique usage of US GAAP that has occurred in the firm, then we will be disclosing that. We will also disclose what are the accounting policies that are being used, principles, concepts, and conventions, whatever we have used will be discussed. And for some valuations, we will have choices. For example, depreciation, we will have to choose from many methods of depreciation. Again, for inventory valuation, you will have to choose from many methods. In that, which method are we exclusively using? Even that will be disclosed in notes to financial statements. And suppose the company wants to enter into mergers or acquisitions in the coming year, that is also an important information for investors or whosoever uses financial statements. And even that will be disclosed. Okay. Yes. First up, we'll discuss about the balance sheet, which is known as SOFP, which is Statement of Financial Position. Okay. And in balance sheet, you can see a combination of measurement basis. Okay. For example, historical cost. For your fixed assets and non-monetary liabilities, you will be valuing them on historical cost. All your fixed assets at the purchase price, at the time of purchase, what was the cost we incurred? Exactly the same we will be entering, followed by accumulated depreciation entries. Then comes current replacement cost. So for inventories, we will have to find out their current replacement cost because it can be subject to some loss of values, which we call as impairment. Okay, at that point of time, we will have to update the values of inventories. Then comes the current market value for available for sale debt securities, both debt and equity. So you will be valuing them at their current market value. And then NRV, net realizable value for short-term receivables and also for some inventories. Then the present value of future cash flows. Suppose in your balance sheet, you are looking at any long-term receivables or long-term payables as it is having a long time period to be settled. It will be affected by inflation rates. It will be affected by the concept of time value of money. And that is why we will have to calculate present value of future cash flows. And it's a compulsion because in our balance sheet, we are not supposed to overstate or understate any balance. It should be exactly stated. That is the reason present value is calculated. Then liquidation value. Liquidation value in the sense if the company is about to be liquidated, at that point of time, what are the liquidation values of all their net assets or all of their assets and liabilities? What are the liquidation values of them? So these are the combination of measurement basis we use for reporting the items in our balance sheet. Okay. Now, there are three important elements in our balance sheet: assets, liabilities, and owner's equity. Okay. And again, in assets, we have two categories: current assets or the non-current assets. Non-current assets, you can also call them as fixed assets. Okay. So in the current assets, majorly you will be finding five categories. That is cash and cash equivalents, your marketable securities. That means trading securities, which you don't have the intention to hold them. You want to trade them whenever it is feasible for you. Then accounts receivable, followed by inventories, and then the prepaid expenses. So for any manufacturing or trading concern, the most important current asset will be inventories. Okay, second largest will be accounts receivable. Now, when it comes to non-current assets, we discuss about PPE, plant, property, and equipment. We know that we'll record them at their historical cost and we will reduce their value according to their accumulated depreciation. Then intangible assets. Okay, so intangible assets, again, they are of non-current nature. Patents, goodwill, franchises, trademarks, all of them come under intangible assets. Then comes long-term investments, non-current investments. So these are the major assets that we could see. Next up, about the liabilities, again, the same two distinctions: current liabilities and non-current liabilities. Okay. So under the current liabilities, again, you'll be majorly seeing accounts payable, wages payable, taxes payable, and bank overdrafts, and also cash dividends payable. Okay. And when it comes to bank overdrafts, there are two sorts of entries that you can make. Both are acceptable. One thing is you can mention them as current liabilities, as we have done here. The other thing, you can directly deduct it from your cash and bank balance and enter the net current assets value. You can reduce it from cash and cash equivalents balance in your current assets. Both the ways it is acceptable. Okay. Then non-current liabilities, your long-term notes or bonds payable, net deferred tax liabilities. Okay. So guys, whenever you find this deferred tax liabilities, it will be non-current itself. Do not confuse it as a current liability. Then contract liabilities. For long-term contracts, you will have contract liabilities and it comes under non-current liabilities. Okay. And there is one more provision available to us. Okay. Suppose you have short-term loans. Let me give you an example. You have taken short-term loans in 2 to 3 banks. Okay. And each of them are in the denomination of 10,000 each. So your short-term debt is, as of now, you have taken loan from 3 banks. So it is 30,000. So you will have an option. Okay. So you can go to some other bank or financial institution and take a long-term loan. Okay. Long-term loan for 5 to 6 years for the same 30,000. Okay. And you can use that to settle off your short-term debt. Now you're converting your or reclassifying your short-term debt into long-term debt. Okay. That is what is that is what happens in liabilities. Okay. Now, how do we classify them as current liabilities or non-current liabilities? Okay. So usually we know that we will take a period of 1 year. Okay. So for 1 year, within 1 year, if you are able to convert any asset into cash, you will classify it as current. And the same thing holds good for liabilities as well. If you are able to pay it within 1 year, you will classify it as current liabilities. That is how we have known it. But what actually happens is you will have to compare between your 1 year time period, that is known as accounting period, or your operating cycle. So, yeah. So let me ask you this question. Okay, guys, how do you define operating cycle? In simple words, what is meant by operating cycle? What is meant by operating cycle? You can give me an equation or you can tell whatever you know about it in simple words. Hello guys, what is operating cycle? How much a business take time to sell or purchase? Very near. Okay. So operating cycle is from the time you purchased or procured your raw materials till the time you have sold the goods to your customers and collected the accounts receivable from them. Okay. From the time you're purchasing your raw materials, and it will then after purchasing, you'll produce the goods, then outbound logistics will be there. You will have to sell the goods, and again, customers will take your goods. Then they will be paying you. Accounts receivable, you will be collecting. This entire time period, that's known as accounting operating cycle. Okay. So now, how do you classify current assets, non-current assets, or current liabilities or non-current liabilities is you'll have to compare 1 year or the operating cycle, whichever is longer, you will take that. Suppose your operating cycle is for 1.5 or 2 years. You'll consider operating cycle for classifying current assets. Whichever asset you can convert into cash within 1.5 years, you will classify it as current assets. Okay. So now there are some manufacturing units related to this tobacco or related things. So they will usually have operating cycle greater than 1 year. So they will choose between 1 year or operating cycle, whichever is longer. Okay. Next up, we have owner's equity. So in owner's equity, there are 6 items that we need to consider. Capital stock, the additional paid in capital, the retained earnings, AOCI, accumulated other comprehensive income, and non-controlling interest, and all as well your treasury stock. Okay. So treasury stock, it is neither our asset or liability or equity. It is none of the three. It is just a contra equity account. Okay. That means its intention is to reduce your equity balance. Now, capital stock, as we know, only the legal value or the par value of your equity shares will be there in capital stock. APIC, any value above your legal capital that you collected will flow into APIC. Later, retained earnings. As we know, retained earnings is the link between our income statement and balance sheet. Okay, so net income, whatever was unused, it will flow into retained earnings. Then comes AOCI, accumulated other comprehensive income. So from the comprehensive income, your other comprehensive income balances will flow into AOCI. It's a permanent balance sheet account. Then comes non-controlling interest. So we shall discuss about NCI in consolidations. Okay. Then treasury stock. As we know, it's contra equity. It is repurchasing our company's shares by paying through retained earnings. Okay. Then we know this accounting equation, which is equity equals assets minus liabilities. In other words, asset equals liabilities plus capital. Then benefits. What are the benefits and limitations of balance sheet? Okay. When it comes to benefits, by looking at the balance sheet, we call it as the statement of financial position, right? So when you look at it, you'll get to know what is the position of liquidity, solvency, flexibility, and risk assessment. Okay, guys. So what is meant by liquidity? Quickly type in your answers. What is meant by liquidity? Or you can unmute and answer as well. Easily converted into cash. Perfect. What about solvency? Good. Which can easily be converted into cash. That's liquidity. Then what is solvency? Ability to pay the long-term debts. Good. Okay. So liquidity is how quickly the company is able to convert its asset into cash. At the same time, how quickly they are able to repay their short-term debts. Okay, both the meanings are there. How quickly we can pay our short-term debts is also our liquidity. Then solvency, how quickly we can repay our long-term debts. That's solvency. Next up, we have financial flexibility, which means suppose there is an upcoming opportunity. We don't know, we never know at what time we'll get good opportunities. We should be financially flexible to take those opportunities. We should have adequate finance available so that we'll take the benefit of the opportunities available. That's flexibility. Then risk assessment. Suppose we don't know when risk occurs in a firm. To sustain that risk, to face the risk, or to take measures against the risk, we will have to have good financial capacities. So all these 4 elements you will come to know once you look at the balance sheet of the company by looking at their current asset position, current liabilities position, and excess of assets over liabilities. You'll come to know all these things. Then comes limitations. So we know that all the assets and most of the liabilities which we enter is in their historical cost, even though that is not their actual market value, we are measuring them at their historical cost. That's a limitation. Then judgments and estimations. So the best example is you will decide what could be the life of the asset for depreciation. So your judgment of the life of the asset can be true or may not be true. That is how it affects balance sheets or in financial statements. Then many assets are not reported. So there is a rule according to US GAAP. If you have any assets that are internally generated, Even though they add value to your company, you're not supposed to enter them because they don't satisfy asset definition. Okay, so many assets whichever are internally generated, you will not write it down in your balance sheet. Suppose Tata company, okay, they have very good created customer goodwill. They themselves have created the reputational goodwill from their customers. That's their biggest strength, but they are not supposed to mention that in their balance sheet. That's the biggest limitation. And one more thing is we follow this concept of survival of the business. Okay, so we assume that business will continue to exist for a foreseeable future. That is again one of the estimates that we make, which may or may not be true. We call this as going concern concept. Okay. So next up. Yes, income statement and comprehensive income statement. Yes. So the major distinction between our income statement and comprehensive income statement is in your income statement, you will enter all the revenues and expenses that are actually resulting out as cash flows. Okay. So the explicit costs, whatever we enter for whichever actual cash flows are occurring, that you will be entering in your income statement, as well as revenues that you are about to generate. So the realized revenues and expenses you will be entering in your income statement. When it comes to comprehensive income statement and especially other comprehensive income, okay, so it speaks about the revenue or income position that we have, but we have still not realized. That is also our strength. But according to the rules that is set in US GAAP, only when we realize our revenue or income, we are supposed to mention that in income statement. So these other comprehensive income, they speak about our change in the currency positions. Okay, so it speaks majorly about unrealized gains and losses. Okay, so in income statement, we'll enter revenues and expenses. Revenues are the inflows that we get from our regular core business activities. Expenses, outflows resulting from core business activities. Or in other words, you can say that in order to earn the revenue, the cash that you're expending is called as expense. For example, to earn sales revenue, you will have to face an expense called COGS. Okay. Then comes gain and losses. So gains and losses, both of them are not frequent activities in our business. They don't result from core business operations. They occasionally occur when we sell assets, for example, or when we win a lottery or when we win a court case. At that point of time, it results in gain or loss. Okay. So if you sell an asset on a value that is greater than its book value, you will call it as a gain. Suppose you are selling it for a value lesser than its book value, it's a loss. Then unusual gains and losses, these are reported as non-operating items. Okay. Unusual gains and losses again might result from your lotteries or from your legal cases. It might result. Then next up, one more important segment is discontinued operations. So what happens in discontinued operations? Suppose there is a failing product line for a company. Nobody wants to continue a failing product line. So they will plan to discontinue that product line. At that point of time, if it satisfies all the necessary requirements. So for considering the operations as discontinued operations, there are many criteria that it must satisfy. Okay, management should have a solid plan, not just a thought, but they should have a solid plan to discontinue the product line, and they should be able to discontinue that product line within 1 year. They should actively search for customers. Then they should be actively engaged in this marketing activities, okay, to search for potential buyers of the asset they want to sell. And there should be considerable value exchange for this product line or any products or any assets that they want to discontinue. So these are some of the criteria that they need to follow. Suppose all of the criteria are met, only then we consider that operation as a discontinued operation. Okay. Suppose we have discontinued operations in the firm only then we will have this distinction between income from continuing operations and income from discontinued operations. Okay. So only then you will be entering this segment of income statement, which is about discontinued operations. And there are two entries that we need to make. First, what is the gain or loss that we got from the sale of the asset or sale of a product line or a department? What was the gain or loss that we got from the sale? Then, what is the tax expense or tax benefit that we got from this operation? That has to be disclosed even. Okay. Next up, what are the limitations of income statement? We know about the benefits. The benefits will be, you will come to know what is the profitability of this company. How are the profits increasing from day to day? And for comparisons also, you can use income statement. What are its limitations? Net income itself is an estimate. Why is it an estimate? Again, income statement values are subject to many assumptions and judgments. You'll be deciding the life of the asset, which will impact your depreciation. You will also decide about the depreciation methods that you're going to use. You're also deciding about the inventory valuation measures that you're going to use. All of these estimates will make our net income value less trustable. The more accurate your estimate is, the more you can trust your net income values. If it is not a good estimate, then net income, we can't trust the values of net income that are generated. Then if it is affected by accounting methods used, again, you will choose between depreciation methods, inventory valuation methods, and again, judgment is involved. Okay, so next up we have other comprehensive income. Yeah, so comprehensive income is nothing but net income plus other comprehensive income. Okay, comprehensive income is all binding. It consists both net income and other items, which we spoke about, the unrealized gains and losses. Yeah, so what are the items that are mostly included in OCI? Foreign currency translation adjustments. Okay, so guys, one thing you guys need to remember is, if you see somewhere foreign currency remeasurement gains or losses, remeasurements will be going into income statement. Okay. And this translation adjustments that take place, it will be in your other comprehensive income. Remeasurement goes to income statement. Translation is there in OCI. Then pension or post-retirement benefits gains or losses, directly you will enter into OCI. Then unrealized gains or losses from your derivative instruments and unrealized holding gains or losses on your available for sale debt securities, and effect of changes in fair value of market risk benefit. And again, if you revalue your assets, revaluation of assets, if you find any gains or losses in this remeasurement, you will be entering that in other comprehensive income. Okay, and one more important thing, if you somewhere find an entry, both the gains or losses or unrealized gain or losses on trading securities, okay, trading securities, even though it is unrealized gains or losses or realized gains or losses, both the entries will go into income statement, not into other comprehensive income. Okay, so two things you need to remember is about foreign currency remeasurement adjustments and trading securities adjustments. Both of them are part of income statement, not other comprehensive income. Okay, then this other comprehensive income changes will be impacting our accumulated other comprehensive income account, which is a permanent balance sheet account. Yeah, and it's a never closing account because it's a permanent account in our balance sheet. Balance sheet accounts never close. Okay. Yeah. So next up, we have it about the statement of cash flows. Yeah. So in the statement of cash flows, we specifically study about what are the cash inflows and what are the cash outflows that are being resulted. Yes. And here we have three main types of activities: operating activities, investing activities, and financing activities. Operating activities, these are the core business operations. The cash inflows and outflows from core business operations are entered in operating activities. Okay. And then in investing activities, the cash inflows and outflows generating from purchase or sale of asset will be entered here. And in the financing activities, the cash that you are collecting as the capital and the principal repayments that we are doing, that comes that comes under financing activities. Okay, now operating activities. So here you will be entering cash from customers, interest and dividend received. And one more confusing point will be dividend received. Okay, even though dividend is relating to your capital, if you receive a dividend, it is entered in operating activities. Suppose you are paying a dividend, that comes under financing activities. Then cash paid to suppliers and any taxes or leaves or fines we are paying, that comes under operating activities. And trading securities. Okay, and one more thing about this trading securities, if that person's main task is trading in securities, if that person is an active trader and their profession itself is in trading securities, only then you will include it in operating activities. If not, it enters into investing activities. Okay. So next up, investing activities, purchase or sale of plant property or equipments, and purchase or sale of investments. If you're not a person whose main business is trading securities, okay, you're not an investment trader, okay, you just for maintaining the liquidity of your business or just for having good investments, if you are purchasing or selling investments, at that time it comes under investing activities. Then loans made or collected. If you are giving loans for somebody else and you are collecting interest from them, that is also considered investing activities. Then acquiring other companies. Yeah, acquiring other companies is also a kind of purchasing another company, which comes under investing activities. Next up, we have financing activities, issuing or repurchase of stock. Then borrowing or repaying debt. Later, paying the cash dividends. Dividend paid comes under financing activities. Then treasury stock repurchases, debt issuance cost, all the things related to your capital entries will come under your financing activities. Okay. Yes. So next up, what are the methods available to maintain our cash flow statement? There are two methods, direct method and the indirect method. In the direct method, you will exactly mention all the asset classes, income classifications, expense classifications. You'll prepare your cash flow statement in very great detail. Okay, by classifying everything, by giving them headers and everything. Okay, but what happens in indirect method? We don't give so much detailing. Whatever is required for calculations, for calculating the value of cash flows from operating, investing and financing activities, only those entries will be there. No additional detailing. Both the methods are acceptable under US GAAP. Okay, and mostly we will be choosing indirect methods. Indirect method starts with net income and we adjust to arrive at the cash from operations. And one more thing in indirect method we should remember is supplementary notes. It's a compulsion. Supplementary notes should be there if you are following indirect method. So what is there in supplementary notes? If any transactions related to interest paid and taxes paid, that has to be given in detail in supplementary notes. Yes. Then about the direct method, it adjusts each income statement line to a cash number. Everything in detail we will be adjusting. Yeah. So now, how do we reconcile our net income? So you know that net income, it is consisting of many cash flows and the items that do not result in cash flows. Okay. But in cash flow statement, we strictly stick on to those transactions which resulted in cash inflows and outflows. But net income is a combination of that. It also has cash inflows and outflows and other non-cash items are also there. So we need to readjust our net income. For that, we have 3 steps. Step 1, we'll be eliminating non-cash income statement items. So mostly seen are depreciation, amortization. Okay. So these depreciation, amortization expenses, as their expenses, non-cash expenses, you will be adding it back to net income. And all your non-cash income items, you will be subtracting from net income. Then in the step 2, removing the investing and financing activity events in income statement. Why are we removing this? Because the first ever cash flow statement that we calculate is cash flows from operations. Okay. To know your cash flows from operations, you should remove this impact of investing and financing activity from net income. That is why we eliminate it. If you have any gain on sale of asset, you'll be subtracting it. If you have any loss on sale of asset, add it back to net income. Yeah. Then step 3, it is about the working capital adjustments. These are important. Okay. So in indirect method, this is exactly how we prepare our cash flows from operations. So it is, if you have any increase in current assets, such as accounts receivable, inventory, and prepaid expenses, you will be subtracting it. Okay. If there is any reduction in your current assets, you will be adding it back to net income. So it's very confusing, right? Why should we add or why should we subtract the increase in current assets, and why are we adding back decrease in current assets? It's a little bit contradictory. I'll tell you why it is so. Okay. So cash flows, we focus only on cash transactions. Suppose your accounts receivable balance is increasing. What does that mean? You're selling your goods on credit. Okay. And there is a customer who had to pay you for the goods that they have purchased. But they have purchased on credit. They didn't give you any cash. And that is resulting as a accounts receivable. That means, look at the seller's point of view. They had to collect some cash from the customers, but they have not collected it. There is a reduction in cash inflows that took place. Okay. That is why if current assets are increasing, that means you had to receive cash from somebody, but you are delaying that for a future period, which is reducing your cash inflows. That is why increase in current assets, you will be subtracting from net income because it is reducing your cash inflows. If there is reduction in your current assets, you will be adding it back to net income. And the opposite with current liabilities. When do you get accounts payable? When you purchase the raw materials from your suppliers, you will have to pay them, but you will postpone paying to them. Okay, you will say on a future date I'll pay. Now cash had to go out of your business in the form of payments to your suppliers, but you are withholding it for a future period. Now cash is present in the company itself. Okay, that is why increase in your current liabilities will increase in cash balances of the company. That is why you'll be adding it back to net income. Decrease in current liabilities will be subtracted from net income. Okay. Yes. So everybody is clear with the financial statements? Any doubts? Okay. So next up, we have an interesting topic, integrated reporting. Okay. So what is this integrated reporting? Yeah. So earlier, before integrated report concept was introduced, all the businesses used to report their financial information only. Okay. In order to judge whether the company is performing well, whether a company is a good asset for the society or not, just if we know their financial information, it is not sufficient. We just know they are profitable. We don't know how they earned that profit, whether it's a legal manner or an illegal manner, or if it's an unethical manner, we don't know. For understanding what sort of a business was that, was it legal, was it ethical, we need some more information added on to the financial statements. Okay. So that was when integrated reporting concept came into existence. So integrated report says that it's a concise communication about how strategy, governance, performance, and prospects lead to value creation, preservation, or erosion over short, medium, and long term. That means how a company is earning profits, what are their strategies, and how are they implementing this strategy. In implementing their strategy, are they impacting any class of the society, or are they impacting negatively to our environment? And then how well are they governed, and what are their performance? Is there any negative impacts for us? Everything will be reported in integrated report. Okay. And then it speaks about value creation for all of their stakeholders. Stakeholder is a person who is associated with the company. Okay. Anybody, it can be your suppliers, customers, or your government, employees, all of them are our stakeholders. We need to create value for all of them. Whether is it happening? There are some business who just create value for capital providers, while other stakeholders will not be treated well. That is not the case that happens in integrated report. They have to create value for all the stakeholders, not only financial capital providers. And then preservation and erosion of their capital over short term, medium term, and long term. So, guys, always remember your financial aspects, whichever you are seeing, it just gives you a short term view on the company's profitability. Only the short term, your financial information helps you. For knowing the long term capability of the companies, you should know their important non financial information, such as their strategy, their performance, their prospects, and all. An integrated report helps us view a company in a short term viewpoint and also in a long term viewpoint. Okay. So, how did this concept emerge? So, the first steps towards integrated report was from GRI, which is Global Reporting Initiative. In the year 2000, they just gave everybody this idea of integrated report, though they did not give us exact format of how to implement this integrated report. They just gave an idea of how important integrated report is. Then there were many organizations which came in middle, but at the end we have SASB, which is Sustainability Accounting Standards Board. These people realized the importance of integrated reporting, and upon that, sustainable practices. Sustainability in the sense we will have to fulfill our needs without harming our environment negatively, without giving negative impacts for future generations. That is sustainability. So SASB, they thought that there are 77 industries and each of them will have different sustainability practices. So they gave them distinct rules and regulations for 77 industries for implementing this sustainability concept. And then we have integrated reporting framework that also emerged, and it was introduced by IIRC. What is the full form of IIRC? Can anybody tell me? What is the full form of IIRC? What's the full form of IIRC? So it is International Integrated Reporting Council. Okay. These were the people who gave us proper framework for integrated report practices. And in integrated report, from point to point, all the capitals that we ever use in our business. So it is of 6 capitals. Okay. Financial, manufactured, intellectual, human, social and relationship, and natural. These are the 6 capitals that anybody uses in their business. So we will have to report on all of them in integrated report. So financial capital is nothing but the capital that we raise from our investors. Then manufactured physical capital means whatever the infrastructure we are using. For example, the roads, bridges that are being constructed by government, and the manufactured physical capital within the company also. For example, plant and equipment that we constructed ourselves or purchased. All of them are coming under manufactured physical capital. Next up, we have intellectual property, the patents and the all the intellectual properties such as your patents and your trademarks, your franchises, all of them come under intellectuals. Then comes your human capital. So human resources are one of the biggest assets for the company. Okay. So if you have talented employees in your firm, again, their competencies, capabilities, and experience acts as a human capital. Then comes social and relationship. When it is a company, it should have some cordial relationships with the society and also its employees. That is spoken in social and relationship capital. Then natural capital. Natural capital means any given company, they will use natural resources such as both the renewable and non-renewable resources. It can be coal, air, water, sunlight, or also the minerals, the precious metals, all of them come under natural resources. A company is responsible for all these capitals. They have to enhance it. None of the capitals should be depleted. That is what we focus on. Okay. There are 7 guiding principles for integrated report, which are strategic focus and future orientation. Yeah, you could see this evidently. We focus on short term, medium term, and long term. Integrated report is designed in such a way that we will have strategic focus and future orientation. Then, connectivity of information. We have not left any of the single capital that helps us. There is a proper connectivity of information from the day we started acquiring the capital till we have improved them. Connectivity information is proper. Stakeholder relationships. You could see we are actually planning to improvise all our stakeholders relationships here. Every capital, every stakeholder is considered. Then materiality. And again here, all the material information should only be included. If there are some immaterial information which is not so important in decision making, you will not include. It's simply a waste of time. Then comes conciseness. Conciseness means as it is more about the non-financial information, the answers should be concise. That means not so elaborative. In a brief manner, in short and crisp manner, we have to deliver this integrated report. Then comes reliability and completeness. In all aspects, integrated report should be complete. It should help us completely understand the prospects of the business. Then consistency and comparability. Consistency means once you're using a specific format of integrated report, you should stick on to that method. From year to year, if you change the way in which integrated report is prepared, users will get confused. Okay. And then comparability. When you maintain this proper frequency in using the same format of integrated report, it becomes easy for comparing against other companies' integrated report. And then what are the benefits and challenges of integrated report? So benefits are better management of financial or non-financial links. Okay. So here the main aim, we didn't speak about the major aim. The major aim of integrated report is to answer your financial capital providers, how their capital is being used and how all the stakeholders' value is enhanced. Okay, value creation is mean and we are answerable to our financial capital providers, how well we are improvising the capital generated. Then, so here, better management of financial and non-financial links of the company and improved internal controls. If there is any deficit in internal controls means it is the control that an organization does to prevent or detect the errors or frauds before they occur and cause negative impact for the firm. Before any frauds and errors are occurring, we take preventive measures or we will find out what are the ways to control these activities before they take place. That is internal control. Okay. Then lower reputational risk. Yeah. So when customers and everybody, every user of financial statement knows everything, every detail about the company, if it is a very good company with very good social motive, obviously their reputational risk will be low. Customers will become loyal for that company. For example, classmate books from ITC. So that still has a lot of loyal customers because of their social motive. They were oriented towards afforestation, to save a lot of trees, to save forests. So that is how they create this loyalty among them customers. Then greater employee and customer engagement. That is what. When your employees and customers know very well about the company, they become more engaged towards it. Then challenges are, in order to implement the integrated report, we need the support of CEO or board. If they reject, then there is no stake. We can't use integrated report itself. Then no established, there is no established proper format for reporting the standards. Okay, non-financial reporting standards are not there. So in integrated report, you happen to see lot of non-financial information. There is no proper format for reporting the integrated reports. Then material issues are hard to define. Yeah. When if it is the case of financial information, any material issues you can easily find out. How would you find out a material issue in a non-financial information? That is again a hard thing. Then disclosure of proprietary information will be risky. So now if you see strategy, governance, performance, all of them are proprietary information, especially your strategy. If you disclose your strategy, it will be a benefit for your competitors. They'll easily understand your strategies. Okay. Now, in spite of so many benefits and challenges of integrated report, what happens in US is there is no compulsion for any company to compulsorily frame this integrated report, except for conflict minerals industry and mining industry. They compulsorily have to create this integrated report because they are in the sensitive areas. They impact the natural environment, mining activities and conflict minerals. That's why it is compulsory for those two industries. For rest of the companies, it's optional. Okay. Now let us look into the framework of integrated report. Yeah, this is the framework of IR. Okay. So the first step is all our financial, manufactured, intellectual, human, social and relationship and natural capital is input into the business. Using all these capitals, we start the business. Okay. So now when you input, you will have to focus on the external environment. Based on the external environment and based on the purpose, mission and vision of the organization, you will design your business model. Okay. Business model is very important. Then your inputs, again, you will have many risks and opportunities, and based on the culture of the organization, you will have to use it. And strategy, risk allocation is present, and your outlook. How do you want to convert them? Then the performance. All of these things will impact your input. When considering all of these factors, you will proceed with your inputs into the business activities. This processing takes place according to your business model. Then you create the outputs. Okay. Outputs are different from outcomes. In your business process and outputs, both of them collectively create your outcomes. Here you decide whether it is creating a positive outcome or a negative outcome for the society. So we call this as externalities. Okay. If it is creating a positive impact, it is a good externality, positive externalities. Suppose it is creating a negative impact, it is harming the society or the natural environment. That is a negative externality. Okay. Then based on the outcome, if your outcome is positive, it will enhance all your capitals. Whatever capital you generated, it will become twofold or threefold. It gets enhanced. Okay, value will be created. Suppose it is a negative externality, all of your capital will be depleted. You will be in a negative position. Okay, so this is our integrated report. Yes. So next up we have another important topic, which is accounts receivable and factoring. Okay. So in the first place, why does accounts receivable even emerge in a company? Okay. So only when a company does credit sales, they will have this asset called as accounts receivable. Okay. So any given company, if they just fix on to this cash sales, the problem of accounts receivable itself will not be there. But companies don't do that. They will have to give credits to their customers. Why? Because of your competitor's strategy. Assume you are a company and you have 5 competitors. Okay. You want to eliminate problems from accounts receivable and you say your customers only cash sales are there. And 5 of your competitors are giving credit sales. All of your customers easily they will go to your competitors because they have credit facilities. Okay. So if we don't offer credit sales, business itself will not exist. 99.9% business don't exist if they don't allow credit sales. That is the reason companies have to give credit sales. Okay. Whenever we enter into credit sales, accounts receivable emerges. Now, Accounts receivable. Whenever you are selling the products, there are two types of discounts that we avail. One is trade discounts and the other one is cash discounts. So what is this trade discounts? If you're a very loyal customer who is purchasing bulk orders, you're giving large orders for the company, and company wants to have more customers like you, then what do? They need to encourage you, right? They will give you discount on your total purchases then and there. Okay. And they will reduce the payable amount. Whatever amount you need to pay to them, they'll reduce that balance. Such type of discounts are known as trade discounts. Okay. And how do you record it? It's a simple reduction in selling price. Next up, we have the cash discounts. So the purpose of cash discounts is you'll give this cash discounts only to people who purchase from you on credit. Okay. The purpose is you need to encourage them to repay your accounts receivable as soon as possible. Okay. That is why to encourage them, you'll give this cash discounts. And how does it sound good? So your cash discounts will be on some terms. Okay. Credit terms. So for example, if it is 2/10 and 30, it means the customer will be getting 2% discount if they pay your accounts receivable balance completely within 10 days. Okay. Suppose they don't pay within 10 days and you have allowed them 30 days to make their payments. For the rest 20 days, they will not get any discounts. They will have to pay full accounts receivable value. Suppose they don't pay in the first 30 days as well. And for the next days, after 30 days, if they cross the limit of 30 days, some companies do charge interest on them and some companies don't. Okay. Now, when you avail the cash discounts, there are two methods in which you can enter it. And guys, whenever it is the case of accounts receivable, in our balance sheet and also in our financial statements, there is a rule that you should not overstate any of your assets, or you should not understate any of your assets. You should correctly state it exactly how it is. Okay, we call this as prudence concept. Okay. Now, according to this, when you sell the goods on credit, none of the seller will be 100% sure that all the credit sales they will receive. None of them will be sure. At least 1% or 2% they will lose the money. That is what we call as bad debts. Okay. Provision for bad debts we create, right? That is for the same reason. Now, when you are sure that you are not collecting 100% of your accounts receivable from your customers, you will have to show those balances in the balance sheet. You are not supposed to enter complete accounts receivable. You should reduce, and whatever you are confident for receiving, only that amount you have to write. Okay. So for that is the reason why accounts receivable entries become a little bit complicated. Okay. Now what happens in the gross method and the net method? There is a rule, right? We are not supposed to enter the accounts receivable which we are sure that we will not collect. Only to what extent you are confident of collecting, only that amount you have to enter. In gross method, what happens? Here in this method, you are giving the discount, right? You are giving 2% discount. Let us say on 10,000 accounts receivable, 2% you are giving discount to your customers. Now, in gross method, you don't know how many customers will avail this discount. How will a company know it exactly? So what they do, they will record the full sale price. 10,000 on 10,000, they'll write it off. Okay, they'll enter it. Then suppose the customer is taking discount. At that time, they will subtract this discount amount. That is 2% of 10,000. They will subtract it. And remaining 9,800, they will be entering. That is in gross method. Then what happens in net method? Here, you will be exactly following your prudence concept. Okay. Now what do? You will assume that all of your customers will take this 2% discount. So from accounts receivable, you will eliminate this 2% discount initially and you will enter 9,800 itself in the first place. Though your accounts receivable is 10,000, you will enter only 9,800 because you are assuming everybody will take discount. Then what happens? Suppose your customers didn't take any discount, then you will consider the sales discounts as forfeited. That means your customers forfeited sales discount. They didn't take benefit of this. Now your net receivable amount again will be 10,000. Okay, so only difference is gross method, you will enter full amount. Only when your customers are taking discount, you will make the adjustments. Net method, you will initially you will subtract the discount and take the net value. Suppose customers are not taking discount, you will add it back to your net value. That is what you do in net method. But net method is very difficult to be followed because each and every customer's record you should know. So what are the remaining days for this customer? And did he forfeit the sales discount or not? Imagine doing this for hundreds of customers. It's a very difficult task. So that is why the companies go through this gross method. Hardly anybody follows net method. Okay. Now comes the main concept, which is CECL model. Okay. So before understanding CECL model, we'll look into one of the formats. Okay. So now we came to know that we are not 100% sure complete accounts receivable I am receiving. I should create some provision for accounts receivable that I don't receive. How do I create it? That is through expectation. We will estimate how many customers might not give me. That is what we call as provision for bad debts. Here we just use a different accounting term. Okay. You remember writing these entries, right? 5% accounts receivable was termed as bad debt. Same thing, same estimations, but here we call it as allowance for credit losses account. Okay, so allowance for credit losses account is a contra asset account. It will reduce your accounts receivable balance to what amount we are confident of receiving. Suppose in 10,000, I am confident that I will receive only 9,000. 1,000 I am not confident. So my allowance for credit losses will be 1,000. Accounts receivable gross balance is 10,000. Allowance for credit loss will be 1,000, which I am not sure of collecting. And remaining net accounts receivable will be 9,000. Okay. Now, how do we calculate this allowance for credit losses? So that is through this account. Okay. And here, the 5 things that you need to remember is, first up, you will be having the beginning balance, which is nothing but yeah, Kavita, can you help yourself? Yeah. Okay. So now what happens? Beginning balance is whatever you carry down from your past year. Okay. Then the second entry will be amounts written off as credit losses. That means you're 100% sure that that customer is not going to pay you. At that time, there is no use in maintaining accounts receivable. You will write it off as credit loss. You will eliminate that 1,000. I was not sure of collecting 1,000. I will eliminate it. No longer I will consider it as accounts receivable. Then collection of previously written off credit losses. And I estimated that in previous year also I estimated 2,000 I will not receive. But fortunately, my customers came back and paid those 2,000 amount of accounts receivable to me. Then I have collected my previously written off credit loss. I will write it here in the third entry. Then in the fourth entry, okay, so this is about your credit loss expense. So what is the purpose of this credit loss expense account? It is only an adjustment account. Why you will use this is to adjust your earlier allowance for credit losses balance to the new balance that you estimated. Okay. Yes. So we'll understand this with a small example. Suppose in the previous year, 2025, I estimated that I will not collect up to 2,000. Okay. This was my T account balance. In short, we'll call it as T account, allowance for credit losses account. In 2026, I am estimating my balance to be 3,000. Okay. Now in your balance sheet also, you will have to make changes to these balances that you estimated, right? So for this adjustment, you will be using credit loss expense account. Okay. Now how do we use this credit loss expense account is, your beginning balance, you will enter it as 2,000. Okay. For this example, assume you don't have any amounts written off as credit losses and you don't have collection of previously written off credit losses. And what is your ending balance estimation? Now you know that your new balance is 3,000. This 2,000, you will have to convert it into 3,000 debit balance. Now, how do we do that? we should have the credit loss expense. Okay. So now, can you guys tell me how will you adjust this 2000 balance into 3000 balance? What will be your credit loss expense to adjust your 2000 balance into 3000 balance? It's very simple. So what is the amount of credit loss expense you guys will view here? What will be the credit loss expense balance? It's very simple, guys. Just look at this account, okay? So now you have 2000 balance here. Your ending balance, you need to calculate, you need to update your beginning balance into ending balance of 3000. What will be your credit loss expense? How will you balance this account? Perfect. It's only 1000. Okay. Now if you adjust this properly, now you can look the math correctly, right? 2000 was your beginning balance and 1000 increment has happened. For that, you will adjust through your credit loss expense account 1000. And that is why your ending balance will be 3000. Most of them will have the doubt how we will get ending balance here. I'll explain how it is. This entry which we are making here, right? It is for next year beginning balance. Okay. This entry, this fifth entry, this is for next year beginning balance. How this account is actually is, when you have beginning balance in credit side, you will actually have your ending balance at the debit side. That is how you carry it forwards, right? Ending balance carried forward. This is how you carry forward. Okay. Now, when you have 2000 here and you need to carry your ending balance forwards, and your ending balance, you know, it should be 3000, isn't it? Now, how you will balance? Now you will get a clarity. Here, the account total, debit column total is 3000. Credit column, you only have 2000. And you can use credit loss expense as a adjustment account. So for that, you will add 1000 here. All of you clearly understood this account? Any doubts? You can clarify right now. All 7 of you clearly understood this account or not? Perfect. Okay then. I'll give you one more situation now. You guys will have to calculate and let me know. Okay. So let the beginning and ending balance requirement will be, yeah, ending balance I'll remove off. So your beginning balance is as given 2000 and you have a credit loss written off, write off. In simple words, it's write off. Okay. Your write off is 1500 and your required ending balance is 4000. Now, what will be your credit loss expense? I'll give you 1 minute time. All of you quickly calculate this. 500, 500, 500. Are you guys sure? 2000. Okay. So beginning balance given is 2000 and third entry we don't have anything. And it is told that write-off is 1500. Okay. Then what is your credit loss expense needed? That is what they are asking us. Okay. If you get confused with this ending balance being written here in the credit side, you can take it down here as well. Okay. Ending balance. Ending balance requirement, that is equal to how much? 4000 you require. Okay. Now, the total that I need for my debit side is how much? 4000 plus 1500. It is 5500. Got it? And here also, just assume that you don't have this ending balance here. Assume that. Okay. And here you need 5500. So what will be your credit loss expense now? How do you balance your credit side? Perfect. It is 3500. So that should be your credit loss expense. Okay. So it's very simple, guys. In exam, only these entries you can expect. Okay. Be clear how you have to calculate. If you master how you have to calculate this credit loss expense, you're done with allowance for credit losses account. Okay. So credit loss expense calculation you should know, and ending balance you can easily calculate it. They'll give you something called as aging schedule. Okay. If you calculate aging schedule, easily you will arrive at ending balance. That is your ending balance. Okay. Ending balance, no need to worry. Now, ending balance, you will know. Beginning balance, they will have given. In some questions, they'll give you credit losses, write-offs they'll give you. Okay. The only thing they will ask you maximum will be credit loss expense. So, you should know how you have to calculate. If you get confused with this ending balance, just take it here. This balance, as they have written here, that is the carried down balance for next year. You can write it down here as well. Okay. Yes. So now is everybody clear with T account? Just learn how to balance your credit loss expense. Yeah. Okay. So this is one of the tricks I taught you, which is easy to understand. If you know any other ways, there are a lot of other ways for calculating. Okay. You know any other ways that gives you right answers, you can go ahead and use that. Okay. Now let us come back to CECL model. So what is this CECL model? There are various models for calculating your ending balance. Okay. So the most that we are using is aging schedule and the CECL model, current expected credit losses model. So for calculating ending balance, you use aging schedule. And for calculating credit loss expense, you will use this current expected credit losses model and T account. Okay. Now, valuation account is nothing but your allowance for credit losses minus the trade receivables. That's valuation. Valuation is nothing but whatever allowance you have given for the credit losses minus the trade receivables minus accounts receivables. That is what will be your valuation account. And this is not tested so much. No need to worry about the valuation accounts. Then how do you calculate? So first step is you will have to calculate required ending balance through your aging schedule. Fix this in your mind. Aging schedule gives you ending balance. Then determine the plug figure needed in allowance account. What is this plug figure? What is the plug figure we are speaking about here? What is the plug figure needed in allowance account? It is nothing but credit loss expense account. Okay. The major player in our T account will be credit loss expense account. So that is our plug figure. That is what we use for adjusting the balances. Then record the journal entry. The mostly tested journal entry will be debiting the credit loss expense account and crediting allowance for credit losses account. Okay. Then there is one more method called as direct write-off method. You know what method, what this follows? Only when cash transactions takes place. That means only when your customers specifically go bad, it says that you will have to record for credit loss expense. That is not how it works. Even though customers are not specifically going bad, if we have that expectation that we will not receive the accounts receivable, we will have to enter that. So direct write-off method, as it says that only when they specifically go bad, you have to recognize, it is not accepted under US GAAP. Okay. And then one more entry that you need to be clear is with this second entry. So for this second entry, if you observe clearly, you can see two accounts here. Okay. The journal entry for recording allowance account, just keep this in mind. Okay. So how do you enter that is allowance for allowance account. I'll write it as allowance account debit to AR account. Okay. They will ask you what will be the net impact of write-off on your accounts receivable balance. So the thing is nil. There will be no impact in your accounts receivable account. You know why? Notice this. Allowance account is your contra asset account and accounts receivable is your asset account. Okay. Both are reducing by the same amount. That means you will not have any impact. According to this entry, suppose your accounts receivable is 2000. Okay. Your 2000 is reducing by same amount. Assume it is 1000. 1000 you have to reduce. Okay. Then what happens with your allowance account? Allowance is your contra asset account and it will have some balances. Let us say 1000. This 1000 also you should reduce by 1000. What will be your net impact on accounts receivable? Look at this. So 1000 in your 2000 balance and in your allowance there will be no balance. So your net accounts receivable will be 1000 itself. There will be no impact. So that is why when written off takes place, there will be no specific impact on your accounts receivable account. You can make a note of it and memorize it. Okay. Yes. Yeah. So this is all what we need to remember in accounts receivable. Practice DT account a lot and also memorize the second journal entry, which we spoke about now. Then, next up, important concept is about the factoring of accounts receivable. This is a simple concept. So what happens is, for the firms or the companies, they will usually have a lot of accounts receivable. Some companies, according to their sizes, they might have it up to millions together. Okay. Then it becomes quite difficult for them to manage this accounts receivable in their company. Okay, millions together, they will have to collect from their customers and most of them don't have time to invest in accounts receivable management. So what they do, they will hire a third party. They will outsource this activity of accounts receivable to a third party. Now, what this third party does, that person is called as a factor. Okay, and I have 1 million accounts receivable which I can't manage properly. I am giving that responsibility to my factor and I am asking him to collect the money from my customers. So, factor will pay accounts receivable to me. He will deduct his commission and fees. And let us say in 1 million accounts receivable, he will give me 0.8 million accounts receivable back. Okay. And he will collect the money from my customers. And to my customers, I will have informed that you will have to pay to the factor. That's the factoring company which will receive our accounts receivable. All of you need to pay to them. That is what we convey to our customers. Okay. Now, when it comes to factoring, again, there are two types. First, factoring is without recourse, and second is with recourse. So what it means is without recourse in the sense, so here I'm selling all the accounts receivable and transferring the credit risk also. In my accounts receivable, not all the customers will pay. Some of them will turn into bad debt, or they will turn bad, they'll not pay. So that risk, that's called as credit loss risk. Okay. That credit risk also I am transferring to the factor. Okay. So that is called as without recourse. If customers don't pay to the factor, that person can't come back to me and ask if I've sold it without recourse. Okay. If I'm selling it with recourse, the factor will come back to me. If some customers they don't pay them, they will come back to me and I will pay back to the factor. I don't want the factor to be in loss. That is with recourse. Okay. Now, usually in the practical world, what happens is with recourse only companies will sell. Because if the factors become very harsh on the customers in collecting accounts receivables, if I am selling them without recourse, factor will have that pressure no matter what to collect from customers. If they are very harsh on customers, we might lose our customers. Okay. That's why we will be giving it with recourse. Yes. Now, when you are giving without recourse and with recourse, you will inform your customers to pay to your factor company. Okay. Now there is another concept called as pledging the accounts receivable. So it is similar to how we pledge our property and take loan. Okay. Companies can pledge their accounts receivable and take loan from the banks. Okay. So here what happens is companies, they will use accounts receivable as collateral for loan. They'll give it and they will take the loan on that and they will return the loan. If not, bank will take over the accounts receivable of the company. Okay. So here the question that can be asked is, in pledging the accounts receivable, ownership of accounts receivable will be with the company itself. It doesn't go to the bank. But when you are selling it on recourse or without recourse, it will go to your factor. Factor will have the ownership of collecting accounts receivables. Okay. So the next concept is about inventory cost flow assumptions. Okay. Yes. So what are inventories? Inventories are nothing but the goods that we have already produced but still not sold. Inventories, again, they have classifications: raw material inventory, work in process inventory, finished goods inventory. So here mainly we are speaking about finished goods inventory. Okay. So now in the finished goods inventory, there are methods of identifying the inventory in our accounts. So there are three main methods. First up, it is about the FOB shipping point. So FOB shipping point. So here what happens is, if the buyer owns goods in transit from the ship of in the moment of shipment, that means I have purchased the goods FOB shipping point from my buyer. From my seller. Okay. So the moment my seller is selling the goods to me, the moment they give it to the shipping department, I am the owner of this inventory. Okay. And then FOB destination. If I am purchasing or selling on FOB destination, what happens is, if suppose I'm selling the products FOB destination to the customers, to my customers I am selling. Okay. So until the goods reach the customer, it will be under my ownership itself. It will be included in my ending inventory itself. If it is reaching the customer, after customer receives it, I will be transferring it to cost of goods sold and customer will recognize in their ending inventory. Okay. Whenever the question is about FOB shipping point or destination, what you need to see is check whether you are purchasing or selling. Okay. Accordingly, you will have to include that in your inventory. Okay. Then consigned goods. So consignment, we all know about it. So consigned goods in the sense, again, this is a kind of outsourcing the sales to your third party. Okay. Now what happens in consignment? I will be sending some of my finished goods inventory to a third party who is known as consignee. Okay. To this consignee, when I give, I'm not selling the ownership of the ending inventories. Okay. I'm just assigning this responsibility to the consignee to sell goods to the final customers. Still, I will be the owner of these goods. Ownership will be with the consignor itself. Just the responsibility to sell to customers will be given to them. And then what happens? Consignee will sell the goods to the customers. Okay. And whatever sales revenue they are receiving, it will be sent to the consignor. They will deduct only the commission part and they will send remaining things to the consignor. Next up, goods out on approval. So goods out on approval in the sense, there are some goods that will be sold for testing purposes, for trial basis. Okay. So you'll give a trial inventory to the customer and it will be for a specific time period. It can be for 1 day or 1 week. Okay. So when you sell it to them on this goods out on approval basis, customers will have to return it back within the trial period, within the time trial period ends. Okay. If they don't return within that time period, then you will be considering it as sold. Okay. In goods out of approval, if customer gives it back within the trial period, then it will be remaining in our ending inventory. If not, by default, we will consider that customer has purchased it. Okay. Then obsolete inventory. So obsolete inventory means this inventory you can't sell it anymore to the customer because it is not according to the specifications. It is not suiting the tastes and preferences of the customers anymore. And at that time, we will be writing it as a loss. Yes. Next up, how do we account for our cost flow assumptions? Okay. So it is with our FIFO, LIFO, average cost or specific identification methods. So FIFO, we know that first in, first out basis. The goods that you are purchasing first will be sold first. The goods that you are purchasing, the latest purchased goods will remain in your ending inventory. And in LIFO, what happens? Last in, first out. So this is applicable to some unique products such as cheese, butter, and so on. Last in, first out means the goods that you purchase latest, that will be sold first. And goods that you initially purchased will remain in your inventory. Then average cost. Suppose your goods are in such a specialized condition that neither FIFO nor LIFO holds good. Then you can choose average cost method. Then for special items such as gold or some customizable goods, which you will number the products. Okay. For them, you will use specific identification. Yes. And there are two methods in which you can maintain the accounts, periodic and perpetual. Okay. In periodic, what happens? Entries will be made only at the end of the period until accounting period. Usually we follow it as December. And from January till December, if it is, until December, you will not record for any inventory value changes. Okay. Only at the year end, you will take the accounts and enter whatever goods were sold and whatever is remaining in inventory. Until end, you will not make it. But in perpetual, every day you will be adjusting your inventory account balances and COGS. Okay. Every day you will be reconciling the balances in perpetual. And again, in periodic and perpetual is complex. At the same time, it's very accurate in nature. Okay. And in both the cases, in both periodic and perpetual, physical inventory count also you should do to reconcile whether physical inventory balances are holding good with the accounting records, whatever you have maintained in periodic and perpetual system. Yes. Then we will have to compare between FIFO and LIFO. For this, let me give you a small numerical example. Okay. So we are considering inflationary period. Okay. In inflationary period, what will be the price of goods? We'll assume that to be 1 because inflationary period regularly it will go on increasing, isn't it? Yeah. This is how prices of the goods are. Yes. Now in FIFO, we will have to calculate COGS and ending inventory. So what is FIFO? FIFO is first in, first out. So in your COGS, you will have 1 plus 2 plus 3. This will be your cost of goods sold value. 6. Okay. And in your ending inventory, you will be having 4 plus 5 plus 6. 15 will be in your ending inventory in inflationary period. Okay. Now what happens with your LIFO? In LIFO, what do you do? For COGS, what you will consider? Last in, first out. So latest purchase goods, you will sell first. Yes, this is what happens in the inflationary period. Okay, as you can see, your cost of goods sold is lowest in FIFO and highest in LIFO in inflation. And at the same time, ending inventory is highest in FIFO, lowest in LIFO. Okay, now let me ask you the question. Now, this being the case, what impact do you have in net income? You can tell me in FIFO whether it is highest or lowest. Yeah, and in LIFO also whether it is highest or lowest. You need to tell me. What is the net income under FIFO and LIFO in the inflationary period? Whether it is highest or lowest. Hello guys, what will be the net income under FIFO? Will it be higher or lower? All of you respond. Higher in LIFO, higher in FIFO, lower in LIFO. Perfect. So it is high in FIFO and low in LIFO. This is all the concept of comparison. Okay. And in average cost, you need not worry. All the values, it will be in between FIFO and LIFO. Okay. So now when it comes to cost of goods sold, under FIFO, it is lower and under LIFO, it is higher. Then what about net income? When COGS is less, net income will be higher itself. In FIFO, it is higher. LIFO, it is lower. Then ending inventory. It is higher in FIFO, lower in LIFO. And income tax. Income tax is directly associated with your net income. If you have high net income, taxes also you should pay more. So tax is higher in FIFO. Tax will be lower in LIFO. Okay. Then what about the cash flows? Cash flows again. Yeah. So cash flows will be lower under your FIFO and it will be higher in your LIFO. Yeah. Just a minute, guys. Yeah. So this cash flows, we are speaking about the cash outflows. Okay. So your cash outflows in your LIFO will be higher. You will be paying more for purchasing the goods and you will be paying less for purchasing the goods in FIFO. Okay. And as you're paying more, your taxes will be less. When your expenses are more, your taxes paid will be less. Okay. If you consider the entire cash flows, net cash flows will be higher in FIFO and net cash flows will be lower in FIFO. Here, the cash flows is about expenses that we got. Okay. Now, what about the LIFO conformity rule? Okay. In LIFO, what happens if LIFO is used for this is what happens in US. You should remember So in US, we accept both FIFO, LIFO and weighted average inventory methods. Okay. Now what happens is, if you are using FIFO, first in first out, for income tax purposes, you can use the same thing for tax reporting purposes as well. Suppose you are using LIFO for income tax purposes, you can't use FIFO for your tax reporting purposes. Okay. If you are using LIFO for income tax purpose, if you are using LIFO for financial reporting purpose, you should use LIFO for tax purpose also. Okay. Now, if LIFO is used for tax, it must also be used for financial reporting. That is what is required by US IRS. Again, guys, in US, there is a distinction between financial income and the taxable income. Okay, for financial income, you will be following the US GAAP rules. For taxable income, you will be using the rules, you will be following the rules by IRS, Internal Revenue Service. Okay, yes. Okay, so now we shall take a break for some time and we'll be starting again from 5. Hello students, are you all back? Shall we continue? Perfect. Okay. The next how do we value the inventory? So the previous slide, LIFO, weighted average methods, we speak about inventory measurements. Okay. So now we are speaking valuation. How do you value the inventory? Okay. So here under US GAAP, we use LCNRV or LCM. Okay. LCNRV stands for lower of cost or net realizable value, and LCM stands for lower of cost or market value. And if there are any inventory errors, we will be noting them now. So first, let us study about this LCNRV and LCM. So LCNRV method is used only when we are using FIFO, average cost or specific identification methods. Okay. So if you are using LIFO, you are not supposed to use LCNRV. It is exclusively for FIFO, average cost and specific identification. Now, how do we calculate the inventory value in LCNRV? LCNRV is nothing but lower of cost or net realizable value. Okay. So cost is nothing but the inventory cost that we have incurred. Net realizable value is we should calculate it. Today we sell the inventory. What is my net realizable value? What value I will get back? That is NRV. Okay. So NRV is calculated as selling price minus estimated cost to sell or complete. Now, if your NRV is lesser than your cost, you will be writing down your inventory in net realizable value, whichever is lower. If NRV is lower, you will write your inventory in NRV. If cost is lower, you will write it in cost in your balance sheet. Okay. Now, when do we use LCM? LCM is lower of cost or market value. It is used for FIFO and retail inventory method. Retail inventory method we don't use. So for FIFO, we will be using LCM. Okay. So LCM is nothing but lower of cost or market value. So in cost and market value, cost we will know already. Inventory cost that is incurred. Market value we will have to calculate. So what is this market value calculation? Market value will be the value, the middlemost value in your ceiling value, replacement cost and your floor value. Okay. So among these three, ceiling, floor and replacement cost, whichever is in the middlemost, okay, that is your market value. Okay. For market value also we have to calculate it. So how do you calculate? Current replacement cost, which is in between the ceiling. Ceiling is nothing but NRV, which is selling price minus estimated costs. And floor is NRV minus normal profit. Formulas, you should know it very well. Ceiling is NRV and your floor will be NRV minus normal profit. Okay. And your current replacement cost, they will have given you. Current replacement cost is also one of the values. So among all three of them, whichever is in the middle, not the lowest, not the highest, you will select that as market value. And now the comparison will be in between cost and market values. Among the cost and market value, whichever is lower, you will be considering that. So that is with respect to LCM method. Okay. Now, write down methods. So when do we have to write down the inventories? So when inventory cost that we have recorded in our accounting books, if it is sold in the market for a very less price when compared to the market, our books. Let us say, for example, I have written my inventory. I have recorded my inventory as 10,000. Okay. But in market, I am able to sell it only for 8,000. So 2,000 will be my write down loss. Okay. And that will be treated according to loss method. Okay. So in this loss method, what happens? Whatever loss you have found out in writing down your inventory, that you will be entering it in your income statement. Separate line in your income statement, you will be writing it. Okay. Now, what are these inventory errors and how do we follow them? Okay. So now when it comes to inventory errors, sometimes Due to many errors such as error of commission, error of omission, or misstatements, there are chances that our ending inventory and beginning inventory values can be miswritten. We will have recorded wrong balances. Okay, that will either lead to overstatement or understatement. Okay, now if your ending inventory is overstated, what is the impact we will know. So in yesterday's class, we discussed that inventory and cost of goods sold are closely related to each other. Okay, and they are inversely related to each other, inversely proportional. If ending inventory is increasing, cost of goods sold will be decreasing and vice versa. Okay, now when your ending inventory is overstated, this will further understate your COGS. They are inversely related. So when your COGS is understated, your net income will be overstated. Okay, very simple. Ending inventory and COGS are inversely related. If ending inventory is overstated, COGS will be understated. Okay, and when COGS is understated, that will overstate your net income. This calculation you should be very clear about. Okay, and one more thing what you need to notice is this year's net income, if it is overstated, that will again impact your retained earnings. Okay, and if your ending inventory is overstated, this year's ending inventory is nothing but the coming year's beginning inventory. Coming year beginning inventory will be overstated. Got it? So that calculation, that assumption also you should be clear about. Suppose they will give you 2 years data and they will ask you to calculate the net impact. And you notice that in 2020, ending inventory is overstated means in 2021, beginning inventory will also be overstated. That calculation also you should consider. Then what are the errors that occur? Yeah, the error reverses in year 2. Okay, error reverses in year 2 means your year 2 net income will be self-correcting itself. You know why? Because in 2020, your net income will be overstated. What happens in 2021? Again, you are understating your beginning inventory. That will further leads to overstatement of COGS. And again, it will lead to understated net income in year 2. Year 1 net income is overstated. Year 2 net income is understated. So it's self-corrected in 2 years. Okay. Then again, the other way around, understated ending inventory leads to overstated COGS, which in turn leads to understated NI. Okay. So next up, cost of goods sold. We know the calculation. Beginning inventory plus purchases minus ending inventory will be cost of goods sold. Next up, when we follow the LIFO, there is one concept called as LIFO liquidation. So LIFO layers are there. So what are these LIFO layers? So LIFO layers means when you time your purchases, each time you purchase the goods, you'll be purchasing it in different prices. Okay. So now when you have different purchase prices, again you will have to record them in terms of layers. Suppose in last year, you purchased 10,000 goods for 50 rupees each. That is a different price. This year price will be increased. This year if you are purchasing 5,000 goods for 55 rupees, that is entered in a separate line. These are called as LIFO layers. Okay. And when you start selling the goods, you will sell the latest purchased goods first. So your latest purchased goods, which is 5,000 for 55, you will sell first. So one layer got liquidated. Okay. So that is called as liquidation. Selling old LIFO layers and matching old low costs versus current high prices. That is artificial NI boost. So in our example, I told you 10,000 goods you have purchased for 50 in previous year. 5,000 you purchased in the current year for 55. Okay. Then what happens? If you have got a customer who places an order for 8,000 goods, this year whatever you purchase for 5,000, you sell that first. The remaining 3,000 you will take it from previous year balance. Okay. But this thing you should remember. Previous year you purchased it for 50 rupees. Now you are selling for 55 rupees. So you are mismatching old balances to new sales price. So that is called as artificial net income boost. Okay. Then you must disclose the LIFO liquidation impact. LIFO liquidation impact means, so there is this concept called as full disclosure, right? we have to disclose all what happened. So LIFO liquidation layers also, you should write it down your notes to financial statements. Yes. And next up, if a company wants to convert themselves from LIFO into FIFO, okay, or they will have to find out the difference in FIFO inventory valuation and LIFO inventory valuation. What they will do? LIFO reserve is calculated, which is the difference between FIFO and LIFO. Okay. And one more thing we have to remember is, in US GAAP, both LIFO and FIFO is accepted. In IFRS, LIFO is prohibited. Okay. So all of you are clear with inventory measurement techniques and inventory valuation methods? Okay. So guys, in section A, as I told you, there are a lot of topics. Okay. So please be interactive so that I'll get an idea which concept you guys are getting and which you're not. Okay. So next up, we have the concept of investments. Okay. What are the two types of investments that we can have in a company? What are the two forms of investments in a company? What are the two forms of investments? Nobody knows. Long-term and short-term investments, yes, can be. Debt investment. Perfect. Yeah, both are accepted. Okay. So here we are majorly speaking about the debt investments and equity investments. Okay. And how do we account for this debt investments and equity investments in businesses? Okay. So there are 6 methods in which we can segregate our debt securities and equity securities, and we can value them. Okay, we'll go through them one by one. All of them are easy. So we know about this distinction: debt securities and equity securities. Okay, and in equity securities also, you can purchase them from public companies. Okay, or you could have purchased equity securities from private companies. Both the chances are there. Suppose you have purchased debt securities, then you will be using held to maturity, method 1. Okay, so held to maturity means you have purchased some, let's take for example, you have purchased government bonds. Okay, and these government bonds, until they mature, you don't want to sell them. Okay, now what happens? How do you need to value them? So you will be valuing them at the amortized cost. So amortized cost is nothing but sometimes government bonds, they will be issued at discount, or sometimes they will be issued at premium. Okay, so those adjustments you will have to make it into your cost, whatever you paid for purchasing. That is called as amortized cost. Calculation of amortized cost is not involved, but you just need to know that HTM are valued at the amortized cost. Okay, and if you have invested in any bonds, regularly you will get interest income. Interest income plus any realized gains or losses, you will be entering them in net income. Okay, and suppose you have some unrealized gains or losses. You will not at all report them. So in HTM, held to maturity, it is very simple. So it is used only for debt securities and you will be carrying them at the amortized cost. Interest income and realized gains and losses will be in your net income. That is how you value them. Then in method 2, it is for available for sale debt securities. Okay, available for sale securities. So here, debt securities, you have bought them to sell them. And both, debt securities, possibly equity if no readily determinable fair value. Just fix it to debt securities, okay? You have bought the debt securities and you don't want to keep them until maturity. You want to sell them as soon as possible, okay? And here, what happens? Such available for sale, always you have to carry them at their fair value on balance sheet, okay? And after you sell those securities, any realized gain or loss, obviously it goes into net income. But here, unrealized gain or loss also we will report it under our other comprehensive income or accumulated other comprehensive income account. You will be entering that. Okay. And here, for available for sale debt securities, if there is any impairment. So guys, whenever you hear this word impairment, just remember this. The cost which you paid for that security is now greater than market value. You purchase the AFS security for 10,000. Now, if you sell it in market, you can sell only for 5,000. You have a loss, right? That is impairment. If you have any impairment, impairment limited to the amount of fair value should be lesser than the amortized cost. If it is lesser than fair value, if it is lesser than amortized cost, then it is impaired. Impairment, you will be writing it down in income statement. Okay. So this is for AFS securities. Then trading securities. So method 3 is for trading securities, both debt or equity securities with readily determinable fair value. Okay. Yeah. So here, just a minute, guys. Yeah. Okay. So here, in the trading securities, both debt and equity securities with readily determinable fair value. That means debt securities as usual and equity securities from public companies. Okay. For public companies, readily you can see their fair value on the stock records. Now, they will be carried at their fair value. And the method that we are going to use is fair value through income statement method. Okay. So in fair value through income statement method, how do we record it? Interest, dividends. Both of them, you will be recording it in your income statement. Then realized and unrealized gain or loss, everything will be in net income. So this thing you should fix in your mind. Trading securities, any given transaction moves into net income. Okay. And here, trading securities, you want to sell them as quickly as possible. Okay. So next up, we have method 4, which is for equity securities which do not have readily determinable fair value. RDFV stands for readily determinable fair value. So these equity you have purchased from private companies. When you purchase from private companies, regularly you can't go and ask them what is the fair value of the equity shares. You can't ask them. Okay. But you need to value the equity securities, right? So now what do? We will be using cost-less impairment method. That means, suppose you'll be knowing, right? Suppose, assume Infosys is a private company, okay? And I have purchased shares of that company. It's a private company. And I don't know regularly what is the fair value changes, okay? And I have paid 10,000 and purchased 5 shares of them. Now what happens? From time to time, I have to check the fair value. How do I do it? I will know, right, whether Infosys is performing well or not. Suppose right now Infosys has a very good reputation. That gives me an intent that fair value is increasing. It's not decreased. Okay. So based on the market movements, I will be deciding the impairments. So here I will be carrying it at a cost less impairment. If there is any impairment, suppose Infosys is its business is falling down right now, at that time I will impair. Okay. Now, if you have any observable price changes of that securities, which is very evident for you, only then you will include the changes. Okay. Next up, we have the equity method. So this equity method and consolidation method, you will be using this when you have significant percentage of equity shares purchased. Equity method, especially if you have ownership of 20% to 50%, you will be purchasing them. Okay. And 20% to 50% ownership, it is called as significant influence. You are a significant owner to them. Your decisions matter because you have a significant percentage of ownership. Okay. Now, how do we value this equity method? So, when you have this 20 to 50% ownership, the way company works itself will go different. Now, you are their very important investor. You need now you have shares of their net income also. 20 if you have 30% ownership, 30% of their net income you have the share of that. Okay. Suppose when you fall under equity method, what do you do is you will directly enter the net income share of the company. You will not wait for them until they declare dividend. It is your income also. You have the right of receiving 30% of your net income from them. So as soon as you have the significant ownership, you will just record the net income, whatever they gain, up to what extent you have to receive from them. Directly you can enter. So now, how do you record the investment? Here, investment carried will be cost that you pay plus share of net income, okay, minus dividends received. If they declare the dividends, that means now you also are the owner, okay. From your net income also dividends are going, that you will be deduct, okay. Then dividends received. If you receive the dividends, you will reduce your investment account, not the income. You should treat yourself as the owner. If you are paying dividends, that is decreasing your net income. Okay. And you will be reducing your investment. Then share of net income. Investors income statement each period. So your net income directly you can calculate from your share of net income. You can directly calculate according to percentage of ownership. Okay. Then intercompany profits are eliminated. Why it is eliminated? Because you are the owner of the other company also. How can you have intercompany profits within your company? Now, if I've purchased 50% of shares in Infosys, I am technically owner of Infosys also. How can I have intercompany profits? That means Infosys should give me this much profits. That is not possible. Both are my companies now. Intercompany profits will be eliminated. But payables and receivables we will be having. Okay. Suppose I have 30% ownership. Okay. I'm still not the owner of Infosys. Only if I purchase more than 50%, I'll be owner. So right now, any payables or receivables if we have, that will be still there in equity method. What happens in method 6? Consolidation. So here you have purchased shares for more than 50%. More than 50% ownership you have. Now you have the controlling financial interest. That means you can control the other firm. All decision-making power is with you. Okay. Now there are two models that we can use, voting interest and variable interest entity. We'll discuss this in next slide. Now, if it is consolidation, what happens? I'll explain. Now I am consolidating with Infosys. I have purchased 80% of their shares. So now I fall under consolidation category. Now what happens? Infosys financial statements, I will consolidate within my company's financial statements because now I am the parent company for two companies combined together. More than 50% means I am the owner of that company. Okay, I will consolidate the financial statements together. Now, both the companies are completely mine. Now, if there are any intercompany profits, intercompany receivables, intercompany payables, I will eliminate all of their impacts. It will be simply like I am sending from my company and receiving in my other company, just like that. So all those transactions of intercompany receivables, payables will be eliminated. Okay. And I mentioned that I own only 80% of Infosys. Okay. Remaining 20% is there, right? that will be owned by other shareholders, which I call as NCI, non-controlling interest. So this non-controlling interest, I have to show it in my equity section. I should mention net income of 20% is non-controlling interest. It belongs to other shareholders who hold 20% of Infosys. I hold only 80% as of now. That is how NCIs will be reported in equity section. Okay. Next up, we will have to understand more about the equity method. Okay. So now what happens here? These are the major points that we should remember. Investment account calculation, we came to know. Cost plus share of investee net income minus dividends received. If there are any stock splits or stock dividends received by the investor, no journal entry. You should stick all these points in your memory. Stock dividends, stock splits leave no journal entries. Okay. Intercompany profits will be eliminated. Intercompany receivables and payables are not eliminated. Okay. And suppose you are changing to equity method. Changing to equity method means, suppose in the previous year I had only 15% of shares of other company, Infosys, let us take. Now I don't fall under equity method. To this year I purchased 10 more percent. I came up to the level of 25%. Now I want to change myself into equity method. How will I change it? So from now onwards, I should not wait until they declare the dividends. As soon as they earn net income, my share of net income, 25% of net income, I will be entering that. Okay. Then changing from equity method means now I hold 25% share in Infosys. I don't want to hold so much shares anymore. I'll sell 10% of shares. I'll come back to 15%. Now I will be moving into the previous method. Okay. Previous method, which one? Method 3 or method 4, which is for equity securities which don't have significant percentage of 20% or more. Now, how do I record it? Now, I will have to record the share of, I will have to adjust the recordings. Now, I can't record any net income changes. Okay. So, in the previous entries, before changing from equity method, what I did, I used to record the share of net income. Okay. I should reverse all those transactions. I should remeasure back to fair value. Okay. And any gain or loss will be recorded in income statement. When you sell, you'll incur this gain or loss, right? That will be recorded in income statement. Okay. Here you can, here it is given as record share of net income. Actually, you don't record share of net income. Okay. So it is like re-recording. That means you have to remeasure it back. Okay. Or else, in one more method, you can understand this. Okay. Record share of net income means before changing from 25% to 15%, I will have some net income share from that company, but they have still not paid me. So that will be recorded as recorded share of net income. And again, you will remeasure back to fair value. Gain or loss, I'm selling, right? From 25% to come back to 15%, I want to sell these shares. From selling the shares, if any gain or loss is there, that will be reported in income statement. Okay. So now what you need to remember, if you're changing to equity method by purchasing more shares, adjust your fair value holdings to current fair values and record the share of net incomes. You can directly record 20% of net income, 30% of net income. When you're changing from equity method, so here you will have to record whatever share you still not received from them. That you will obviously record. You should receive it from them. Then remeasure to fair value of those equity securities as you do in method 3 and 4. Then gain or loss, you will be recording in income statement. That's all. Okay. Now, what about the business combinations? Okay. Here, business combinations, you are purchasing the other company, right? That can be in two circumstances, either on goodwill or bargain purchase. When it is goodwill, when you are paying more than the fair value of net identifiable assets. Okay. So I am paying more money to them than what it is worth of. So the difference between purchase price and fair value of net identifiable assets will be called as goodwill. Next up, we have bargain purchase. Bargain purchase means I'm not even paying to that company to their extent of real worth of net assets. Okay. At that time, what happens? Fair value minus purchase price, it will be a gain for us. Okay. So next up, push down accounting. Acquirer's basis used for acquirees' assets or liabilities. Yeah. So in push down accounting, what happens? Acquirer is the parent company who acquired its subsidiary. So here what happens? Suppose I am acquiring Infosys. I will have, suppose Infosys is using IFRS and I am using US GAAP. Okay. I will push down my accounting practices to that company. I will tell them that from now on, US GAAP needs to be followed and I will consolidate their financial statements. That is push down accounting. Okay. Then non-controlling interest. NCI, we discussed about this. And then comes proportionate consolidation. So what is this proportionate consolidation in the sense? Line by line, you will divide it from non-controlling interest holders and controlling interest holders. Suppose equity, let's take this example. I am purchasing 80% of Infosys. 20% is NCI. So what do I do? In equity section, 80% controlling interest I will show. Next line, I will show 20% NCI. Same thing with assets. For every line on balance sheet, you will do this. For assets also, 80% I'll show as my assets, 20% NCI. Okay, like this, every line you will be doing it on your balance sheet. That is proportionate consolidation. Okay, and it is not permitted under IFRS. Okay. Now, when you are consolidating, there are some eliminations that you will be doing. So when you're consolidating, one thing that you should keep in your mind is, now you are owning the other company as well. Two companies, you are the owner. So you will eliminate any intercompany receivables or payables, sales of inventory, sales of fixed assets, bonds or loans. Everything will be eliminated. And eliminating parents' investment account versus subsidiaries in equity. That means earlier, before holding this consolidation, my investment account will be there in name of Infosys. Now, anyhow, I have acquired that company, right? No need of maintaining investment account. Then, adjust the depreciation. Fair value, if it is greater than book value, more depreciation will be there. Fair value, if it is less than the book value, less depreciation will be there. No need to worry about this. You will come to know. Okay. If fair value of the assets are greater, obviously you should carry more depreciation and vice versa. Next up, we have the important concept, variable interest entity model and voting interest model. So what happens here? Yeah. So in voting interest model, you should have the financial ownership of greater than 50% votes plus significant decision-making power. This significant decision-making power is very much important. Suppose you only own more than 50% of shares. Suppose I only own more than 50% of shares in Infosys, but I don't have controlling power itself. Even though I am technically owning more than 50% shares, they'll not consider my decisions at all. At that point of time, I can't consolidate because how will it be your company when you are not given the authority to decide? No, at that point of time, consolidation will not happen. You should have significant decision-making power because if it is your company, you should have the decision-making authority, right? If not, how can be that our company? That is why without decision-making power, significant decision-making power, consolidation never happens. Then, and in questions also, if they tell you more than 50% of shares you are having, but decision-making authority you don't have. Okay. At that time, will you consider for consolidation? Yes or no? I'll repeat it again. you have 60% of shares in Infosys company, but none of your decisions are considered by the Infosys company. You just contribute 60% of their shares. Do you consider it as consolidation? Yes or no? Hello guys. Yes or no? Is that consolidation? Okay. Now we understood the question. What about remaining students? Very good. The answer is no. Okay. So why it is no? Because here you just contribute 60% of Infosys company shares and they are not at all considering your opinions or decisions. How will it be consolidation? That is why the answer will be no. In voting interest model, if you have more than 50% of financial shares with them, decision making power should be also more than 50%. Okay, so next up we have about the variable interest entity model. Okay, so in this variable interest entity model, what happens is there will be so many companies and none of the companies will have more than 50% of shares. Okay, now what happens is suppose one company can have 30% shares, other can have 40% of shares, remaining companies will have 20% shares. None of them have more than 50% shares. Now what will I do? I will search for the company who has maximum percentage of capital, 40% in this case. Okay, then what happens? For that company I will consider as the primary beneficiary. Okay, this primary beneficiary, they will consolidate all the financial statements of other small companies. Okay, this is how variable interest entity model works. Then even if parent has majority shares, if minority has decision making power, no consolidation. This is what I told you. Be very careful with this decision making power. That's very important. Okay. Okay. So we'll move on to the next topic, which is PPE, plant and equipment. Yeah. Property, plant and equipment, the depreciation and intangibles. Okay. Yes. So this concept is important now. Depreciation methods. Okay. So here there are 4 methods of depreciation available for us under US GAAP. You can choose one among them according to what sort of business yours is. Okay. For example, if they are related to airplane industries. Okay. So they will be mostly using units of production. Or suppose it is an industry which has almost equal amount of sales throughout the year. They'll be using SLD. Okay. So like this, based on the type of organization, you will be choosing depreciation methods. Okay. Now, in this depreciation methods, the formulas that we need to know is about the depreciable base. Depreciable base is initial purchase cost minus the salvage value. Okay. So whatever cost, initial purchase cost, how do we record it? It is purchase cost of the asset plus the cost that we have incurred until we install that asset in the business. That is our initial purchase cost. Okay. Then minus any salvage values involved. Then you will be getting your depreciable base. One more important formula is net book value. Historical cost minus accumulated depreciation will be net book value. Okay. And in US GAAP, there is no upward revaluation. So what is this upward revaluation in the sense? Let us say I am entering my asset as 10,000 today. Okay. And in market, my asset's actual value is 12,000. I can't revaluate it upwards. That means I can't increase the value of asset in US GAAP. Not at all possible. But if it is IFRS, we can do it. You know why? Because in US GAAP, there is a compulsion for us. Only historical cost we should use in the valuation of assets. Okay. But in IFRS, what happens is both historical cost is accepted, and they can also choose for fair values of measuring their assets. Fair value valuation of asset is there in IFRS. In US GAAP, it's not there. That is why upward revaluation is not possible in US GAAP, but in IFRS, it is possible. Okay. So guys, you should give importance to this US GAAP and IFRS distinction wherever it is given. Because in MCQs, there are a lot of chance they ask you this. Then the method one, straight line depreciation method, the easiest one. Okay. So you'll be calculating depreciation expense. How do you do it? Depreciable base divided by useful life of the asset. You will be getting equal depreciation every period. Okay. And you can also calculate straight line depreciation rate, which is either 1 divided by useful life you can take, or you can take it as depreciation expense divided by depreciable base. That is also possible. Okay. Moving on to double declining balance method. So in double declining balance method, depreciation expense will be equal to book value multiplied with 2 into straight line depreciation rate. Okay. Straight line depreciation rate you will anyhow calculate multiplied with 2. And one thing you should be careful is in DDB, you will be taking book value, not depreciable base. Okay. Then, so DDB, yeah. So double declining balance, sum of the year's digit and units of production. All the three are accelerated systems. You know why they are called as accelerated? Because in the initial years, lot of depreciation expenses observed, and in the later years, very less depreciation expenses observed. Okay. But straight line method, equally you will observe it throughout the period. Now, moving on to sum of the year's digits method. Yeah. One more thing. Yeah. In double declining balance method, what happens is based on book value, you will depreciate it. Okay. And in the final year, the calculation will be different. You know what you do? You'll be adjusting to reach the salvage value exactly. That means whatever is the remaining net book value, you will subtract the salvage value from net book value. In the final year, you will subtract the salvage value from net book value, and whatever amount remaining that you get, that is considered as final year depreciation. This thing you should be careful. Okay. Then comes SYD, sum of the year's digits method. So here, you need to calculate SYD. Okay. And SYD, how do we calculate? It's through the formula n into n plus 1 divided by 2. Okay. So here, suppose the useful life of the asset is 5 years. So 5 into 5 plus 1 by 2. That is, you will be getting it up to 15. 15 will be your SYD. Okay. Then you can substitute it into the formula. Okay. So suppose depreciable base, you take it as 10,000 multiplied with, if it is an asset with 5-year life, for first year, you will be taking it as 5 divided by 50. Okay. So for first year, 5 divided by 15. For second year, 4 divided by 15. Third year, 3 divided by 15 and follows on. And the last year, you'll be taking it as 1 divided by 15. Okay. This is how you calculate SYD. Next comes your units of production method. Here what happens is, initially you will find out what will be the depreciation expense per unit. Okay. So it will be depreciable base divided by total estimated units. So your depreciation expense will be equal to depreciation per unit multiplied by actual units produced. Okay. Suppose you are producing 1000 units and your depreciable base is 10,000. Per unit, your depreciation expense will be 10,000 divided by 1,000, 10 rupees. Okay. 10 rupees, if you produce 5,000 units, then your depreciation expense will be 5,000. Sorry, 500 units if you produce, your depreciation expense will be 5,000. Yes. Now, all these 4 methods that we read was for financial reporting purposes. And in US, financial income is different from taxable income. Okay. For financial income purposes, any of these 4 methods you can use. But for tax calculations, there is a restriction. You can only use straight line depreciation method or MACRS. Okay. SLD, when you're using for tax purposes, no salvage value to be deducted. Complete cost of the asset is considered as the depreciable base. 100% of the asset value will be depreciable base when you calculate it for tax. Then MACRS. So MACRS is very simple. Okay. So what they do is they'll give you what is the percentage of depreciation you want to consider. Based on that percentage, you will be calculating your tax expense. Okay. Yes. So next up, plant property equipment, recording and their impairment. And also intangibles and goodwill. Yes. Okay. So in the plant property and equipment, we know that we will be recording them at their historical cost. Okay. Historical cost minus any accumulated depreciation. This is how we record them. Suppose your book value at what you are entering your plant property and equipment is 10,000 and your market value is 12,000. Book value is 10,000 and your market value is 12,000. Now, what will you get? Will you get a loss on selling this PPE or will you get a gain? Your book value is 10,000 and the market value is 12,000. So, asset value has decreased or not? Obviously, it is decreased. Market value, now it is 12,000 and now your asset value, what you are entering is 10,000 itself. Comparatively, value is less. Okay. What the book value, what you are entering is less. Okay. So now you are not going to make any changes. As far as your cost in your book, asset cost in your book, if it is not greater than your market value, you are not going to make any changes. It will be there in the cost itself. Suppose your market value is 8, if it becomes 8,000 and your book value of inventory is 10,000. Now what happens is your market value is less. If you sell that asset which you have entered as 10,000 in your books for 8,000, then obviously you are going to incur loss, right? So that chance we are not going to take. So the moment you find that you are not able to sell your inventory at any higher cost than the cost at which you are mentioning the book value. Okay. If you know that you are not able to sell it for any value greater than book value. Okay. Let me put it in other way. Okay, guys. So market value, if it is 1,000, assume. And if your book value is 8,000, 800. At this point of time, no changes. In your books, the PPE will remain at 800 itself. Suppose book value is 800, market value changes to 700. Now a problem arises. Okay. Now we know that if we sell this particular asset as of now, 100 rupees loss we are going to get. Okay. And in our US GAAP, it states that if you don't get profits or revenue also, it's okay. If you are in the position of loss, immediately you have to recognize. That is what they say, isn't it? So that is why we record for impairment. Okay. So now you will be recording for impairment and you will bring down your asset value to 700. This is the value that you will get if you sell it in today's market. Okay. This is why we impair them. Okay. Now the test. How are you going to test it for impairment? Sum of the estimated future undiscounted cash flows versus the carrying value. Okay. Suppose carrying value is lesser than or equal to the sum of cash flows. Your asset is not impaired. Sum of the cash flows means whatever money you are able to get, the market value that you are able to get for your asset, it is greater than your carrying value or book value. Okay. At that time, it is not impaired. No write down needed. The problem will come when your future cash flows that you are getting or the market value, suppose it becomes lesser than your carrying value. Okay. Yeah. Suppose it becomes lesser than your carrying value. At that time, the problem occurs. You are not able to sell the asset for anything greater than your carrying value. At that time, it is impaired. You have to write it down to fair value. Okay. So now, how do you record the impairment loss? It's very simple. Carrying value minus the fair value, and it will be recognized in the current period income statement. Okay. So it's very simple. When your carrying value is greater than the market price that you're able to get from that asset, it is impaired. You're not able to sell it for profit at all. At that time, you have to impair it, and impairment loss will be recorded. Carrying value minus fair value will be recorded. Okay. Now, in US GAAP, there is no subsequent reversal of impairment losses permitted. Okay. So now let me tell you the benefit of IFRS. So what happens is, we spoke about this impairment loss. When market value will become less than the carrying value, we will impair it. We'll record impairment loss. Okay. Now, let us say in the next year, 2026, we are recording impairment loss. In 2027, due to so many reasons, the sum of cash flows became greater than our carrying value. Okay. Now we are in a good position. If we sell that asset, we'll get more profits. Even when we come back to that net position, you are not supposed to reverse this impairment loss in US GAAP. Whatever it is, now you are entering it in 800. Next year it is becoming 1200. You will not increase its value. 800 only you will enter. But what happens in IFRS? You can reverse it. Impairment loss reversal is possible in IFRS. What happens is, suppose you have recorded impairment loss of 200. Okay. And you can reverse it. For your inventory value of 800, you can add back that impairment loss of 200. You can value it at 1000. Reversal is possible in IFRS, but not in US GAAP. Okay. Now coming up with our intangible assets. Okay. Intangible assets are those assets which you cannot touch or feel, but it just brings in value for our business. Okay. And in intangible assets, there are two types: finite life and the ones with the infinite life. Okay. So intangible assets with the finite life, in the sense, you will be able to calculate amortization for it. Okay. So what is this amortization now? For fixed assets, you will be calculating depreciation. Likewise, for intangible assets, you'll be calculating amortization. Both of them are same, but the terms are different because we should distinguish between fixed assets and intangible assets, right? That is why you call depreciation for fixed assets and amortization for intangible assets. Okay. Now, for finite life, anyhow, we can calculate amortization. What do we do with the intangible assets that have indefinite life? You can't calculate amortization, right? So those assets with indefinite life are not amortized, but they are tested for impairment annually. Okay. And the best example for indefinite lived assets will be our goodwill. Okay. Now, I'll explain goodwill later. Okay. So first we will look into the intangible assets that have finite life. Patent. Patent legally has 20 years of legal life. This is legal life. Okay. Suppose you are able to make the use of this patent only for 10 years, then you will have to consider the life of patent as for 10 years, not 20 years. Though legal life is for 20 years, you should consider the useful life of patent for that matter, any given intangible assets. Useful life is what you should consider when you are calculating amortization, not the legal life. Then, defense costs can be capitalized. That means, suppose you have won this patent on a legal case. Okay, that legal cost, only when you win the patent in legal case, that defense cost you can add it into patent cost. You can capitalize it. Okay, then comes copyrights. Copyrights for movies we have seen, for books we have seen copyrights. So what is the life of this copyright in a sense? Life of the author. Suppose author lives for 80 years, 80 plus 70 years. Okay, so it will be somewhere around 150 years. 150 years will be there for copyright. Then it will be left public. On public platforms, you will be getting it, such as Google and all. Until 150 years, you will not get it. You will have to take permission and use. After 150 years, it will be left for free use for public. Then trademark. Okay. Trademark also we can amortize because it has a maximum of 40 years of life. After that, you can renew it by paying fees. Then franchises. So franchises means contractual right to operate under franchisor's name. Suppose I want to start Starbucks branch, okay, in my place. Then I have to get the franchise from them, okay. So I have to get a permission from Starbucks main branch that I'm starting one of their outlets in some other place. So that is called as the franchise. Now, after getting it, I can start a Starbucks store and I can use their flavors and I will be able to generate profits, and some of the profits should be shared for them. However, it is written in franchise. They will have to follow. Okay. Then comes leasehold improvements. Okay. Leasehold improvements. What happens here? You have to amortize for the shorter of the lease agreement period or the leasehold improvements life. Okay. Suppose, let us say, for example, I have taken a building on lease. Now what happened? For this leased building, I have built a separate cabin that is adding value for the leased building. Now, it's an improvement. That is an asset that I have given. Okay. Now I have to amortize it for a shorter. How will I amortize it? I will check the life of this extra cabin that I added to the building and the lease period. Whichever is shorter, I will amortize it over there. Okay. Then comes our goodwill. Okay. So how do we treat goodwill? Goodwill is an intangible asset. It doesn't have any definite lifetime. Okay. Now what happens when goodwill is resulting is when the purchase price is greater than the fair value of net identifiable assets, goodwill results. Now it will be only recognized on acquisition, not internally generated. I told you, right? Tata company, even though they have the reputation from customers, the goodwill generated from their customers, they can't write it because it's internally generated. Only acquired goodwill can be written. Okay. And you are not going to amortize this as well because it doesn't have a finite life. It has indefinite life. So we have to test it for impairment. How do you do impairment test? Fair value of reporting unit versus carrying value. Suppose I have bought Infosys on this goodwill. Okay. This Infosys, it's not performing well now. If it's not performing well, reputation reduces. So at that time, I got a hint that this fair value of Infosys now will be less than its carrying value. That time, I will have to calculate for impairment. Suppose after getting this doubt on Infosys value, I conduct an impairment test. And if fair value is greater than carrying value, no impairment will be there. Suppose fair value is less than the carrying value, impairment loss should be recorded. Okay. Then, so how do you classify the asset has held for sale criteria or that? So now I told you, right? This holds true with our discontinued operations also. Okay. These are the conditions that you will be holding when you convert an asset into discontinued operations. When you have a plan for discontinuing your assets or product line, these are the criteria you need to follow. It has to be met. First, when management has to commit to the plan to sell, then asset should be there available for immediate sale. Active buyer should be there for purchasing that asset. And sale should be probable within 1 year. And it should be actively marketed at a reasonable price. And plan unlikely to be withdrawn. That means you have fixed it that you are going to sell that asset. And you should not withdraw your plan. Okay. So these are about our asset valuations. Now what happens is, important thing that you need to remember is how to calculate impairment for PPE, how to calculate it for how to calculate amortization and impairment for intangible assets and goodwill. Okay, and these conditions they are all simple. Yes. Next up, we have the records for liability, especially for income taxes, leases, and warranties. Now, we'll discuss about the income tax records. Okay, so now I told you that in US, there are two types of income calculations. Can anybody tell me what are the two types of income that we calculate in US? What are the two types of income that we calculate in the US? Perfect. Financial income and the taxable income. Okay. So why there is a distinction between financial income and taxable income? According to US GAAP, we will have to calculate according to their concepts, conventions, and principles and all. So that is why financial income is calculated in income statement. That will be different from taxable income, because taxable income, you will pay taxes only based on your cash transactions, right? So the tax that we pay on the actual cash transactions that took place. That is why taxable income will be different from financial income. Taxable income we will have to report according to the rules by IRS, which is Internal Revenue Service. This is the body that has the authority for tax collections in US. So there are separate rules for calculating taxable income and separate rules for calculating financial income. Okay, that is why this concept deferred tax asset and liabilities is existing. Okay, now when it comes to differences between financial income and taxable income, there can be two types, temporary and permanent. In temporary, what happens is, you will be entering your transactions on a different time in your financial income and taxable income. Let us say, for example, the rent you have received in advance from your customers. Okay, when you receive rent in advance from your customers, that is next month's rent, this month only you have received. That is prepaid asset for you now. You're not going to enter it in your income statement. Why? Because it is for the next period that you have received this period itself. This month only you have received the next month's rent. Okay. Now what happens? That is a liability for you, not income. Why? Matching principle. Expense and revenue should belong to the same period. So next month itself, that client is using your asset, and only then you will have right to receive or recognize the rent received. This period when you're receiving, it's your liability. You'll be entering it as the income received in advance as a liability. Okay. So now what happens in financial income? No income is recorded for this rent received in advance. But in your bank statements, it will clearly show, right, that you have received the rent from your client. Then what happens? According to tax purposes, you will have to record this. You will have to pay taxes on rent received in advance. So rent received in advance is not considered in financial income, but it is considered under taxable income. Okay. Next period, that is next month, what happens? You will record this rent received in advance in your financial income, but not in your tax income. Okay. That is called as temporary differences. When it comes to permanent differences, there are some incomes in US which are not taxed at all. Okay, suppose you are investing in any government bonds that are tax exempt. Okay, you need not pay any tax on the interest that you are receiving. And dividends also, there are some criteria. If criteria is met, dividends are also not taxed. So such type of differences will be called as permanent differences. You are not at all considering that for your taxable income calculation, but in your financial income, you are considering that. Okay. Next up, corporate tax rate that we need to pay according to Tax Cuts and Jobs Act. Now it is 21%. Okay. And now due to this lot of differences between financial income and taxable income and all, this TCJA Act, you know what it did? It brought something into existence called as book tax conformity. That means no difference should be there in financial income and taxable income. Okay, whatever financial income is there, for the same thing we should pay tax. That is what the rule was brought by TCJA Act. That was effective from Jan 2018. That means right now we are following this book tax conformity. Okay, now earlier, before this book tax conformity, there used to exist this permanent and temporary differences, right? Permanent differences we need not worry, but temporary differences we will have to calculate them. For that, we will be using asset liability method. Okay, under asset liability method, it will result in deferred tax liability and deferred tax asset. Okay, now everybody open your chat box. I will be giving you an example. You should tell me whether you get a deferred tax liability or a deferred tax asset. Before that, I'll explain what are these two concepts. Deferred tax liability occurs when your financial income is greater than taxable income. Okay, financial income, due to various rules and regulations that you follow, you have entered financial income as 50,000 and you have entered taxable income as somewhere around 30,000. The cash transactions that took place only equal 30,000. Okay, now the tax that you need to pay should be on this actual 50,000, but according to IRS rules, you are paying on taxable income which is 30,000. Okay, so you are paying less than what you are supposed to pay. That creates deferred tax liability. Why deferred tax liability? Because in the next period, you will have to pay more tax. This period, you should have paid on 50,000 actually, but you have paid only on 30,000. That means for 20,000 income, you still didn't pay tax expense. Okay, so it becomes your outstanding expense. When you are not paying, it becomes outstanding expense for you. That therefore, it creates deferred tax liability. Okay. Next, what happens is deferred tax asset. Here, what happens is you are paying a tax on greater amount. 50,000, you are paying tax. But your financial income is actually 30,000. So for 20,000 income, you are paying tax even though you have not incurred it in this period. That will create a benefit for you called as deferred tax asset. Why it is deferred tax asset? Now, additional income tax that you are paying, that will be considered as tax paid in advance, right? That becomes your prepaid expenses. It's a asset for you. So it will be considered as deferred tax asset. Okay. Now I will tell you a transaction. You should tell me whether that results in deferred tax liability or deferred tax asset. Okay. So the transaction is you are paying your insurance premium for the 1 year in advance. Okay. 1 year's insurance premium in advance you are paying. Now tell me whether this creates deferred tax liability or deferred tax asset. Think over and tell me. I'll give you 2 minutes to think. I'll repeat the transaction. Your paid insurance premium for 1 year in advance. This month itself, you paid off all your insurance premium. In this month, will this transaction result in DTL or DTA? Hello guys, what do you consider it as? Okay. So what happens is, this month itself, you are paying all your insurance premium. Okay. 10,000 complete, assume 10,000 completely you are paying. This month itself you are paying. Cash has gone out. 10,000 cash has gone out. But what happens in your income statement? You will not recognize this expense completely in this period itself. Gradually throughout 1 year, you will go on recognizing it. Okay. Now what happened? In your tax, your taxable expense is, in your tax income calculation, expense is more. In your financial income calculation, expense is less. What happened? Taxable income now is reduced. Financial income is more. Okay. Clearly, you can say that it is DTL when financial income is greater than taxable income. Okay, guys, I'll write it down. You should think fast, okay? It's very simple. See, insurance premium. What happened? This is May. In May month, you are paying 1 year premium in advance, isn't it? Assume you are paying 12,000 per month. It was valued only for 1,000. At the stretch, you are paying off 12,000. Okay. Now what is happening? In your taxable income, tax calculations, what happens? Complete on this 12,000, you will be treating it as expense. Cash transaction has taken place, right? That's what. Then what happens with your income statement? Here, 12,000 completely you will not consider it as expense. It becomes prepaid expense for you. Prepaid expense is your asset. Okay. So, 11,000 will be in your prepaid expense account. Only 1,000. That is May month expense only you will take. Okay. May month expense is how much? 1,000. According to matching principle. Okay. Now what is happening? In your tax calculation, now tell me, taxable income will be less or more? All of you. In this transaction, your taxable income is less or more? Tax expenses 12,000. Financial expenses, how much? 1,000. Okay. Now what happened? Taxable income is obviously, it will obviously be lesser than financial income. Why? Taxable expense is more, financial expense is less. So, taxable income will be less than financial income. So, which results in DTL. Okay. All of you understood this scenario? All of you respond. Perfect. Okay. Now I'll give you one more scenario. All of you need to answer. Okay. Suppose you are receiving rent in advance. You are receiving rent in advance. It results in DTA or DTL. When you receive income in advance, it results in DTL or DTA. Sorry guys, I was on mute. Okay. Yeah. So it is deferred tax asset itself. Perfect. Yeah. So when you are receiving your rent in advance, what happens? Cash inflows is more. When your cash inflows is more, the tax that you want to pay is also more. Taxable income will be more than your financial income. Okay. When taxable income is more than financial income, that will be your deferred tax asset. Perfect. Yeah. So next up, we will move into our permanent differences. Permanent differences, as I told you, there are some income for which you need not pay tax at all in US. Municipal bond interest is tax exempt. Dividends received, for if it follows a criteria only, it will be tax exempt. Okay. Now, what happens here? There is no temporary differences. When you have permanent differences, you'll not pay tax on such income. Okay. Then what happens? DTL and DTA will not be there. DTL and DTA will be there only for your temporary differences, not for permanent differences. Next interesting thing is about net operating loss. Okay. What happens? Let us say 2025, my company earned huge profits. In 2026, due to the war that is taking place in Middle East, I'm in huge losses. Okay. Now, as I'm in a loss position, I have this choice. Okay. I can carry forward this loss indefinitely or carry it backwards for 2 years for receiving the tax benefits. Okay. If I carry forward indefinitely, what I will do in 2026, I have got this huge loss, right? So I can carry forward it. Suppose in 2028, assume I've got less income and I don't want to pay more taxes. At that time, I want to make use of this tax carry forward benefit. Now I will carry forward this tax benefit into 2028 and 80% of my taxable income there, I will be getting exempt from this and I will pay lesser tax. I can carry forward this benefit for future periods indefinitely, but only 80% of the future taxable income will be offset, not more than that. When you carry it backwards for 2 years, now I feel that in 2026, I've suffered so many losses, and in 2027, I want some money to run my business. I'm in a serious loss situation. Then what I'll do, I'll carry it back for 2 years. Okay. Then I will take refund for tax pay. Then I'll have some more money to run my business. Okay, you can carry forward indefinitely, and maximum 80% will be reimbursed. 80% of your future taxable income will be offset. If you carry it backwards for 2 years, refund of tax payment will be there. Next up, how do we represent this balance? How do we represent this DTA and DTL on our balance sheet? So you will be netting off your DTA, DTL within the same tax jurisdiction. Suppose I have many branches. I have branch in India, UK, USA, Korea, Japan. Now I will have to present them in our balance sheet in the sense DTA and DTL offsetting is possible only in same tax jurisdiction. In India, I can offset DTA and DTL of India. Okay. Then in China, that company's DTA and DTL I can offset or net together like this. I have to present this data separately for different jurisdictions. For India separately, China separately, I will have to present. Then yeah, valuation allowance applied to DTA when realization is uncertain. Okay, so valuation allowance is applied to DTA in the sense, suppose there are some tax rate variations. Okay, at that time, valuation allowance you need to charge. This majorly we will use when we are taking the benefit of this net operating loss. You can carry forward indefinitely, carry backwards for 2 years, right? When you're taking the benefit of that valuation allowance, you will calculate, because there are chances that after 10 years, US can increase or decrease their tax rates. Tax rate variation will be there, right? For that valuation allowance, you will have to calculate. Just need to know about this. Calculations will not be tested. Okay, so is everybody clear with this income tax concept? All 6 of you? Perfect. Okay, guys. So we'll take a break for 5 minutes because again, too much influx of the knowledge at the time might miss out some points. We'll take a break for 5 minutes and we'll start with lease accounting. Okay, guys. So we shall continue. Yes. So leases, both financial and operating. Okay. What is this lease? What is the purpose of this lease in the sense? There are some companies who operate on a very small scale and they do need assets such as plant property and equipment, and it will usually consist of a huge amount of payments that we need to make for it, and these small companies will not be able to afford for it. At the same time, they will not be able to even take loan of that huge amount. At that time, one of the options they have is leases. Okay, so lease is a type of agreement where we find two people, lessors and the lessees. Okay, lessor is the owner of the asset who will give the asset on lease for the people or such small companies, and lessee is the person who is taking the asset on lease from the lessor. Okay, now there can be two types of leases, financial lease or the operating lease, and the purpose between them is also different. I'll explain that to you. So first, before analyzing the purpose between finance and operating lease, what does a lease actually create? It creates both right of use asset and lease liability. How? I'm a small company and I have taken PPE on lease. Okay. And I'm getting an asset for using. And at the same time, in return, I will have to pay them lease payments. Okay. Now what happens? I will have to record both asset, right of use asset and lease liability on my balance sheet. Okay. And as I told, lessor is the owner of the asset, lessee is the user of asset. Yeah. And right of use asset that we are recording is an intangible asset. Why? Because asset, when we record, we have to own our asset. And when we own it only, we can write it as our asset, our company's asset. This leased asset, I'm not the actual owner. Owner is still the lessor, but he has given me the right of using this based on an agreement. So that is why I can't record it as a fixed asset in my company. It will be an intangible asset. Why intangible asset? This lease agreement that I signed, that is my asset, not the PPE that I'm getting on lease. That is why that agreement is an intangible asset. Got it? Now, how do we classify finance lease or operating lease? There are 5 conditions. Finance lease. So, for if these 5 criteria or at least any one of them is met, that lease becomes a finance lease. For example, when ownership transfers to lessee at the end of the lease term. First, let me tell you the purpose of this finance lease. Why companies use this finance lease, because suppose I am a company and I want to own a particular plant property and equipment. Okay, my intention is I need to purchase it, but I don't have cash and I'm not able to take bank loans also. It's very huge interest. Now what I will do, I'll go to a lessor and I will look at his assets. Whichever asset I feel it worthy enough for my money, I will ask him to give that asset on lease to me. Okay, I'll not tell him my intention that I need to purchase it. I'll ask him to give that asset on lease to me. And I will satisfy any of these 5 criteria so that that person will sell that asset to me at the end of lease term. Okay, so my intention is I need to purchase that asset at the end of lease term. That's why I go, because what is the reason? I don't have cash to purchase the asset, neither do I have proper bank loan. What will I do? I'll go and take a finance lease on that asset. It's like purchasing the asset on a smaller or on a slower pace. As your lease term comes to an end, you will have purchased that asset. So that will be the purpose with finance lease. So any of the 5 criteria, one or more of the 5 criteria should be met. First one, ownership is transferring to the lessee. To me, in my example, I was the lessee. So ownership will transfer to me at the end of the lease term. Okay. Then lessee has purchase option. I have the option to purchase that asset at the end of lease term. That was my intention for entering into finance lease. So I have to purchase that asset. Then lease term covers major part of asset's economic life. More than 75% of that asset's life, it should be on lease term. Then present value of lease payments should be greater than or equal to substantially all of the asset fair value. That means present value of the lease payment should be greater than 90% of the asset's fair value. Okay. Then asset should be of a specialized nature. That shouldn't be of any use for anybody else. It is useful only for my company. It is in a specialized nature. If one or more of these conditions are met, that's a finance lease. Or else it is an operating lease. Okay. Now, finance lease and operating lease, how does a lessee account? That means the small company that is purchasing that, how will they account for it? So in finance lease, they will have to record right of use asset. It is recorded as any other asset. Initial cost plus lease, initial lease payments plus initial lease direct costs minus incentives received. Then lease liability, present value of lease payments that we are paying. Then in income statement, separate interest expense plus amortization expense. Why do we record this? For any leasehold improvements that you have done, you will have to record this. Amortization expense and separate interest expense you have to record. And principal repayment will be considered as your financing activities, and interest that we are paying on lease will be our operating activities. Okay. Then comes our operating lease. Here, right of use asset plus lease liability recognized at commencement will be same as finance. That means as you are recording finance lease, same way you will be recording operating lease. On income statement, single cost. In finance lease, you will separate interest expense and amortization expense, right? But in operating lease, both of them combined together, single lease cost you will recognize. And in statement of cash flows, all payments, that is operating activities, all payments will be treated as operating activities. Both your interest payments and amortization expenses will be treated as operating activities. Then short-term lease. Okay. So there are two forms of leases, short-term and long-term. Okay. If the lease agreement is for 1 year, at that time, companies usually will not show interest in recognizing lease asset, lease liability, and complicating the lease recognition process. So what do? They will expense it on straight line basis. As we do for any other assets, we'll be doing it on a straight line basis. Expense will be recognized. Then no right of use asset or lease liability will be recorded. Because it is simply waste of time. For short-term leases, it's not a benefit for us. It will be a more costly process, complex process. That is why we choose this method. We'll expense it on a straight line basis. Okay. Yes. Next concept is about warranties. Okay. What is this warranties? So we as customers, we have purchased so many products. Okay. Especially when we purchase home appliances such as washing machine or refrigerator or television. Usually we will get warranties, right? Up to 1 year warranty, up to 5 years warranty. Okay. So those types of warranties for which we need not pay anything, company itself gives. Such type of warranties is known as assurance type warranties. And there are some special warranties as well, especially the one with the iPhone. Okay. You can subscribe for their warranty plans. You will have to pay them initially. And after that, any damage happens to your iPhone, they'll repair it for free. So such type of warranties for which we pay and take from the company, that is service type warranty. Okay. First up, we'll look into assurance type warranty. Okay. So here, look in the company's perspective, what happens? This warranty. Okay. So this warranty, what happens? We are not paying anything. As a customer, I'm not paying anything. The company on their side, they're giving it for me. That is assurance type warranty. Okay. Now, in the company's perspective, what happens? They're not collecting any additional money for this. So they don't see this as a separate performance obligation. So what is this performance obligation in the sense? Okay, I'll give you one example. If I'm purchasing both television and refrigerator from a supplier, according to the supplier, there are two performance obligations. He has to sell television also for receiving the consideration. He also has to sell refrigerator. Okay, these two considerations, there are two performance obligations to him. Suppose I am purchasing only television for which he is giving us assurance type warranty, then there is no separate performance obligation. Only one television he is selling, only one performance obligation. Okay, that's why it doesn't create any separate performance obligation. And when it comes to accounting, you will be recording the warranty expenses on the percentage of sales. Okay, on the percentage of sales, in the sense they will give you such as warranty expense will be 2% of sales. 2% of sales will be your assurance type warranty expense. So expense completely you will be recording in the same period. Now you can ask me why matching concept doesn't come into existence in assurance type warranty. It is because this is not an expense that you are incurring in cash. It's an estimated expense. Okay. And you never exactly know when your customer will demand assurance type warranty from you. That is why initially itself, when you sell television or any other appliance, immediately you will record this warranty expense. Okay. Then comes warranty liability. Warranty liability only you will enter it as total warranty expense recognized minus costs incurred on claims. Suppose the customer starts asking warranty from you, up to the extent of warranty that you have cleared for them, you will reduce your warranty expense. Okay. How do we classify this? Current or partly current plus partly non-current warranties. That is based on the number of years for which the company is giving us the warranty. If it is within 1 year, for 6 months, 8 months, it is considered as current warranty. If it is for greater than 1 year span, non-current warranty. Okay. Journal entry at sale. What you need to record is debit the warranty expense account and credit the warranty liability account. That is how you record. Journal entry when claim is settled, it will reduce your warranty liability. Debit your warranty liability and credit whatever you settled for. This is assurance type warranty. Okay. Then comes service type warranty. I'll give you iPhone example itself. iPhone, for 1 year, assume they have given you assurance type warranty. You want extended warranty. Okay. What do you tell them? You say, I'll pay you whatever it charges for service type warranty. I want it. Then what they do, up to 1 year, you will be eligible for assurance type warranty. After 1 year and until the life of that iPhone, you will be eligible for service type warranty. Okay. So service type warranty is an extended warranty and it creates separate performance obligation. And here revenue will be deferred until warranty services are provided. Okay. And usually it is recognized on a straight line basis. Suppose I've paid them 1,000 and the service type warranty they are giving me is for 10 years. They will charge 0.1 per 1 year. Okay. It's recognized on a straight line basis. Alternatively, you can also recognize it on proportion to expected costs. If you know what could be the expected costs, based on that, you will be recognizing it. Okay. Then consideration received. As soon as you receive the consideration from them, you will be entering it as a contract liability on balance sheet. Now, what will be our journal entries? Journal entry at sale will be debit cash because you are receiving cash for service type warranty, right? That is why it creates separate performance obligation. Okay. Then you will be crediting contract liability, unearned revenue. Then again, when you provide the service, it will be contract liability account debit to revenue account. So how it works is on a straight line basis, you have recognized it. Suppose this year straight line basis warranty service type warranty expense that I need to recognize is 1,000. Okay, I'll notify this as a revenue. Suppose customer is coming and asking for service type warranty, I'll give them. Suppose they don't ask, this 1,000 will be my revenue for that period. Okay, that is how service type warranties work. Yes. Key things that you should remember is assurance type warranty is free and no separate performance obligation is there. Service type warranty you should pay and separate performance obligation is present. Okay, so yeah, so there is the last section, last two sections, owner's equity, dividends and treasury stock. I think we can continue this tomorrow. Okay.